Hello everyone and welcome to this session where we would be discussing about the much dreaded consolidated financial statements in your CA inter syllabus. So to be honest, this is a standard or a chapter which I would say is fairly scoring. That is contrary to what you usually hear because people are usually a lot more scared for consolidation. Having said that, this is a very standard chapter in terms of the process that you will have to follow and the typical types of adjustments that will come, and institute will usually mix and match within that. There is not a lot of variety that will come beyond that, and hence this is something which will be very scoring for you, I'm very sure, for your exam. So let us get started. So when you're looking at consolidated financial statements, there are three standards which are within the larger bucket of consolidated financial statements. There is AS21 which applies to subsidiaries. There is AS21 for that. There is AS23 for associates, and there is AS27 for joint ventures. Now, when we want to understand each of them, before that, we need to understand what is meant by consolidated financial statements and what is separate or standalone financial statements. So usually, if you have a company, for example, like Reliance, and Reliance has a 70% investment in Reliance Jio Limited. So in the separate or standalone financial statements, it is the statements of Reliance and Reliance alone. And hence in that statements, I will show the investment in Jio as a separate line item. That is about it. And that investment will be recorded as per AS13. Usually these are long-term investments and hence they will typically be shown at cost. However, in case if it is a current investment, you show it at lower of cost or fair market value as per AS13. However, when we look at a consolidated financial statements, for all practical purposes, can we say Reliance and Jio are one and the same? Now, legally they may be two separate entities. However, practically they can be said to be a part of the same group, and as a result, the corporate wheel that is there in the middle, we want to lift that at the stage of consolidation and treat the parent and subsidiaries at least as one common group and show the performance breaking that legal barriers and breaking the legal form. So when we are looking at consolidation, section 129 of the Companies Act requires companies which have a subsidiary at least to mandatorily prepare a consolidated financial statements in addition to their separate financial statements. So obviously Reliance will have to make its SFS or separate financial statements, but in addition it has to compulsorily also prepare a consolidated financial statements including the parent and subsidiary both. Now practically companies like Tata Steel, Reliance have hundreds. Like Tata Steel, for example, has close to 600 different subsidiaries. However, from your CA Inter perspective, you will be asked a question of maximum one parent and one subsidiary. You will generally not have more than one subsidiaries. More than one subsidiaries will go into your final CA. And hence, we will focus on having a consolidated financial statements in case there is a single subsidiary. Over here, the holding company is a company which has more than a 50% stake of the paid up share capital, or more than 50% of the composition of the board of directors is under our control. That is when we say that we are having control over the subsidiary. Now there are three special terms. First, there is control. Control refers to the position where we have more than 50% of the paid up share capital or a control over more than 50% of the composition of the board. Second, you have something called a significant influence. Significant influence results in an associate relationship where you have more than or equal to 20% stake all the way up to 50% stake where you don't have the ability to direct. However, you can exercise what we call as influence, that to a significant influence. And third, is something called as joint control, which results in a joint venture relationship. So over here in this session, we are going to focus largely on control, that is a subsidiary relationship. For associates and joint ventures, we will do the working separately. So over here, what are the features of a full consolidation method? For a subsidiary, full consolidation method refers to the method where we will consolidate all assets and all liabilities of the subsidiary in the consolidated financial statements. Now, what are the key features of this method as given by AS21? First, consolidation will happen from the date of acquisition and will continue till the date you have control. So, this will continue when the date parent acquires control, will continue till the time the parent has control. The moment it sells its controlling stake, consolidation of that subsidiary will stop. Now, you might be holding it, like Walmart holds an 85% stake in Flipkart. You might be holding an 80% stake in your subsidiary. However, you have the ability to direct the entire net assets of the subsidiary in a manner you want. Like there is a 100-acre land with Flipkart. With an 80% stake, Walmart can decide to do whatever is to be done with the entire 100 acres. Not just 80 acres, not just 20 acres, with the entire 100 acres. And hence, you consolidate 100% of the asset and liabilities line by line. However, we have an only 80% stake, which means for the remaining 20% stake, we create what is called as a minorities interest, where we say that as a percentage, 20% of the net assets of the subsidiary, land, building, machinery of the subsidiary is attributable to a minority interest holder, and hence we'll show a separate minority interest line item in our balance sheet. So over here, all items of assets and liabilities, incomes and expenses will be consolidated, the entire 100%, irrespective of the stake that you are acquiring, whether 50, 100, 51%, 100% stake, it does not really matter. Okay. Now, we said that this is the reason why minorities interests are actually born, because you are acquiring 100%, you are acquiring 80%, but you are consolidating 100% or 20% is due to someone else, will be shown as minorities interest, which is a separate line item between shareholders' funds and non-current liabilities. Next, we say that in my separate financial statements, usually I will be given the separate financial statements of the parent and the subsidiary, and I'll have to join the two. But in my separate financial statements, I will be seeing the investment in subsidiary. Now, if I'm taking over the assets and liabilities of the subsidiary, I cannot again show the investment. And as a result, I will eliminate the investment. In my consolidated financial statements, there will be assets and liabilities of the subsidiary which will be joined. But then I will not again show the investment in subsidiary. I will eliminate it. In lieu of that, what will I eliminate against that? So on one side, investments will be eliminated, and on the other sides, you will have the share capital and the reserves as on the date of acquisition. Remember, like when you do amalgamation, etc., you will have on one side debtors, on other side creditors, which are intercompany, you eliminate it. In a similar way, if there are 100 shares in Geo, 70 shares of Geo are held by the parent, that is appearing as investments in the parent's books, and that will be eliminated against the share capital which is appearing in the Geo's books. However, the 30 shares which are not acquired by the parent will be shown within the heading of minorities interest. So I will eliminate the investment made by the parent in the subsidiary against the share capital of the subsidiary. However, the investment does not just give me access to the share capital. It also gives me access to the reserves as are existing as on the date of acquisition. Higher the reserves, higher will be the net worth, and higher I will have to pay PC, purchase consideration. Lower the reserves, lesser is the consideration I'll have to pay, and hence when I'm acquiring a company which has a huge reserve base, I'll have to pay more consideration. A company which has a lesser reserve base, I'll have to pay lesser consideration, and as a result, I will compare the investment, as you can see, eliminate the parent's investments in the subsidiary against the parent share in the subsidiary's net assets or even net worth as on the date of acquisition, that is the equity share capital plus the pre-acquisition reserves. The difference, if any, on such an acquisition will be shown as goodwill or capital reserve. Sir, why? Well, if the subsidiary had net worth or net assets worth 1,000 and I have a 70% stake, ideally I should have paid 70% of 1,000, that is 700. However, if I've ended up paying 850 rupees, then the extra 150 that I've paid is due to the reputation, goodwill of the company, and hence I will show this as a part of goodwill. However, if I've paid only 650 rupees for something which is worth 750, then I'm getting a bargain and I'm paying 50 rupees less, but that is a profit on purchase, and a profit on purchase is shown as a part of capital reserve rather than taking it in the P&L account. Usually we take it to P&L. When you sell the items, here you're merely purchasing a company and you're recording a profit. It is a special profit, and hence it is taken to the capital reserve. Now, after the acquisition, if you keep on earning profits, now these are profits which are earned under the control of Walmart. So if Flipkart के अंदर Walmart has acquired an 80% stake, and after the acquisition of Flipkart, there is still profits after the date of acquisition. This was usually not the case in amalgamation because the acquiring company would have closed. The company that got acquired would have closed. However, in case of a consolidation, there's a holding subsidiary relationship, and hence the subsidiary company, maybe Flipkart, maybe Jaguar and Land Rover, these companies will still continue, and hence they will keep on earning profits. But I can say 80% of the profits belong to the parent, 20% of the profits belong to the minorities. So post acquisition, whatever are the profits earned, 80% of them will be attributable to the parent and will be consolidated along with the parent's P&L. These are called as post acquisition or revenue profits, because these are profits which are earned under the control of the parent. However, the 20% of the profits will not belong to us, it will belong to the minorities, and hence you will add it to the minorities interest. Now, how do you calculate minorities interest? The share in the subsidiaries net assets which are not attributable to the parent is attributable to the minorities. Minorities can be calculated using proportionate net assets method. Net assets of a subsidiary can be calculated as assets minus liabilities or share capital plus reserves. Now, minorities interest is a percentage of share capital plus the reserves, and this is 100% minus the parent's holding. Again, minorities can be calculated by preparing ledger account or by preparing a statement. Okay, next you have the reserves of the subsidiary need to be analyzed. This is the most important thing between pre-acquisition and post-acquisition. Why? Well, the reserves that were earned prior to the date of acquisition, I as a parent have not earned them. In fact, I'll have to pay consideration to purchase them. But profits which are earned after the date of acquisition are under my control, my management, and hence I have actually earned them. And hence they will be consolidated. And then again, these profits belong to parent and minorities both. So they should be attributable to parent and minorities both. Now, the presentation format over here can be that you can prepare a cost of control working or a ledger, like realization you prepare. In case of companies which are closing, you can even prepare a cost of control. But institute usually shows a statement, and hence we will also solve it in a statement format. So what are the general principles we remember? Till now, Section 129 of the Companies Act mandatorily requires us to prepare consolidated financial statements in case we have a single subsidiary or more than one subsidiary. Subsidiary relationship arises when there is control, and control arises when you have more than 50% stake in the paid up share capital or control over more than composition of more than 50% of the board. If the relationship is that of a subsidiary, you will apply the full consolidation method as studied under AS 21. AS 21 outlines a few features of this method. First, you will start consolidation from the date control exists and continue consolidation till the time you have control. Second, you will take over all 100% of the assets and liabilities irrespective of how much stake you have acquired. Third, you will eliminate the investment that you have in the subsidiary in your SFS with your share of the equity share capital and the pre-acquisition reserves as on the date of acquisition, and excess, if any, will be attributable to goodwill or capital reserve as the case may be. The part which is not attributable to you, so if you have 70% stake, the remaining 30% of the net assets or net worth is attributable to the minority interest holders, and you have to create minority because you are consolidating 100% of the assets and liabilities when you have only a 70% stake. Further, after the date of acquisition, the company still has its own legal form, and hence it might continue operations and it might earn profits. Out of those profits, 70%, that is parent share, will be attributable to the parent in the consolidated profit and loss. These are revenue profits earned under my control, whereas the 30% additional will be attributable to minorities. Usually the goodwill as determined on the acquisition date will continue to remain the same. However, minorities interest will keep on changing as you keep on getting more and more profits, and even there can be possible losses. Okay, now the general steps that you will need to follow in case of a consolidation process are: first, you will draw up your schedule 3. If you have to prepare a consolidated balance sheet, drop your schedule 3. It will be similar to the regular schedule 3 that you prepare in other chapters, except over here when you give the name, it will be H limited, for example, and its subsidiaries. You will write the words and its subsidiaries, and then you write the word consolidated balance sheet as that. Then when you prepare the balance sheet format, your regular format will continue. Shareholders' funds, non-current liabilities, current liabilities, then assets, non-current assets, current assets. The regular format continues. There's two things that you'll have to add. One is minorities interest, that is to be added between shareholders' funds and non-current liabilities. And second, you will add goodwill along with the intangibles on the asset side. This is unique to consolidation. Minorities interest is not there in any other chapter. It is there in consolidated financial statements. A separate line item: point 1 shareholders' funds, point 2 minorities, point 3 non-current liabilities, point 4 current liabilities. So you'll prepare a blank schedule 3 format. After that, you'll write down a note on all the assets and liabilities. All the assets and liabilities will be written. If you can mark the adjustments to a particular asset and liability, if there is an adjustment, like in PP, there may be a fair value adjustment, or in inventory, there may be an upstream or downstream sale of inventory adjustment, or in a debtor or a creditor, there can be an intercompany mutual indebtedness or mutual owing elimination adjustment. We will study that. But if there are adjustments, then you can write down, let's say PP of, let's say H of S, and leave around 4 lines. Then go to the next line item, let's say inventory of H, S, leave around 4 lines, and then go to the next one. So wherever there are adjustments, you have enough space to write down the necessary things. Alternatively, you can even prepare it in a tabular format, or you can prepare it in a vertical format, the notes. However, you'll write down all the assets and liabilities except for the share capital and the reserves and the investment in the subsidiary. These are the items which you will have to separately analyze. Now, when I look at my final balance sheet, my assets and liabilities are to be consolidated, but not my share capital. And hence, my share capital will represent the share capital of the parent only, because the subsidiary share capital will be eliminated against the investment, or it will be shown along with minorities' interest. And hence, your share capital will only represent the parent share capital. Second, when you go further, you are still left with the reserves of both the parent and the subsidiary. You're still left with, you're still left with your share capital of the subsidiary and investment in the parent. Over here, at this stage, you would prepare separate workings. Okay, so over here, if I can just pull that up for you, if we have made it somewhere. Okay, so you will have an analysis where we would mention consolidated reserves. So you'll have consolidated reserves, and within those consolidated reserves, you will have standalone parent. Over here, you will get the balances. Just a second. Yes, so over here you will prepare 3 working notes. First is the consolidated reserves. Now in my consolidated reserves, I'll obviously start with the standalone reserves of the parent. For parent, the profits belong to the group only. Within subsidiary, some of the profits may be belonging to the minorities, but for parent, everything belongs to the group. So you'll take the standalone reserves of the parent from P's balance sheet, and we'll do this better, understand this better with sums. So you'll have the general reserve, P&L, whatever other reserves. Usually these are the 2 common reserves. Leave around maybe 7 to 8 lines, and then you prepare a working note for goodwill. Now you can either prepare it in a ledger format, or you can prepare it in a statement format. Now if you want to see the statement over here, you can just focus this on your screen. You will have goodwill workings, and you can loosely call these goodwill workings even as cost of control. Now for your goodwill workings, you'll have to compare, usually like you do in amalgamation, purchase consideration with net assets to find the goodwill. However, the purchase consideration over here will not be separately shown, but your investment, which is there in the parent's books for the subsidiary, that must be your investment. So that is your purchase consideration, PC. Now usually in amalgamation, you can directly compare the investment or the PC with the net assets, because in amalgamation, the selling company closes, and if the selling company closes, the difference over here between the PC and the net assets will be attributable to goodwill. However, the investment, that is PC, you compare, for example, with net assets. Over here, we take our share of the net assets. Why? Because you might have an 80% stake. So your investment is only 80%, and hence, in order to correctly calculate goodwill, you need to compare it with your share of 80% of the net assets. Now, usually you need the net assets as on the date of acquisition. However, in almost every question that you will see in the exam, you will not have the balance sheet as on the date of acquisition. You will have a balance sheet 1 or 2 years later, and hence you will have to back calculate. Well, for net assets, it might be difficult, but can we say that the net asset, that is asset minus liability, is also equal to the net worth, that is share capital plus reserves? And as a result, we can compare investment, that is PC, with our share of the net worth. I'll again repeat, we'll compare PC with our share of the net worth, and hence over here we will compare investment with our share of net assets or net worth. Now, because you don't have the net assets as on the acquisition date, maybe the acquisition date is 1st April 24, you have the balance sheet on 31st March 25, you don't have the net assets on the 1st April 24, but you have the share capital, which I assume remains the same. And in the notes, somewhere the question will tell you that what is the P&L balance or reserve balance as on 1st April 24. So you can back calculate and find what would be the net worth. And accordingly, you can try to find the goodwill over here. Now, in the net worth, there is share capital plus pre-acquisition profits. However, share capital is not entirely attributable to the parent. Maybe if there's an 80% stake, can I say 80% of the share capital will be attributable to the parent? The remaining 20% will be attributable to minorities. Okay, so at this stage, if you reach up to this point, you would have taken, for example, the standalone balance of the parent. So we have taken the standalone reserves from the parent. We have also taken the investment from the parent's books. Also, the share capital from the subsidiary's books is taken. So at this stage, if you have meticulously solved, you're only left with the reserves of the subsidiary and the adjustments that would be given in the questions. So for that, you'll need a working note number 4, where you'll need to analyze the reserves. Sir, but why do I need to analyze the reserves of the subsidiary? Because, and how do you analyze the reserves? Something like this. Why do I need to analyze the reserves of the subsidiary? Well, because assets and liabilities are to be 100% consolidated. However, reserves are not to be 100% consolidated. Reserves belong to parent and minorities both. However, you don't just attribute blindly whatever is a reserve 80-20 to parent and minorities, because some of those reserves would be earned prior to the date of acquisition, and that parent share in the pre-acquisition reserves will go in finding the pre-acquisition net worth, whereas some reserves are earned after the date of acquisition. These are the reserves after the date of acquisition, post-acquisition profits, which will be consolidated along with the parent's regular reserves because it is under parent's control. And hence, what would you do? Well, you will prepare this 4-column table where you will have particulars, then you will have total, and try to segregate between pre and post. Now, based on the given data, you will look at the opening balance, which will usually be given in the notes somewhere, then closing balance of the P&L, which will be there from the balance sheet printed in the question, and if there is any dividend, you will subtract the dividend, and then the balancing figure, if any, will be attributable to the profit and loss for the current year. Now, you will have to segregate between pre and post. Usually, the opening balance is prior to the date of acquisition and hence will be pre. The profit during the current year depends. If the date of acquisition is at the start of the year, 1st April, then the entire 12 months will be post-acquisition. It is earned after the date of acquisition. But if the date of acquisition is somewhere in the middle of the year, let's say 1st July, then 3 months will go in pre, 9 months will go in post. So this is 3 months and 9 months attribution between pre and post. And you will find the split between pre and post. Now, there might be a lot of other adjustments which we will study, like fair value adjustments, depreciation, various adjustments we will study, and then you will come to the adjusted balance. This adjusted balance will be attributable to whom? Sir, to parent and minorities, and hence you will attribute this to parent and minority, for example 80-20. Now, when you do that, we will say that this part is a parent share in the pre-acquisition profits, and hence will be attributable to goodwill workings. Whereas this part over here is parent share in the post-acquisition profits, which will be going in working note 1, that is a consolidated reserves. For minorities, it does not really matter whether these are pre or post profits, they will go into the minorities working directly. And if you apply this properly, now you have analyzed the only remaining thing, and then you will scan through the question if there is anything else remaining, like an intercompany debtors or creditors or bills payable, bills receivable, which we will try to eliminate. And then you will work backwards. Post each of these items, then reach, for example, your workings where you will find the goodwill, the consolidated reserves, the minorities interest. Then you will total up every asset and liability after all the adjustments that were there, and then post the number into the balance sheet. Now, this might all sound to be very, very intimidating. To be honest, it is. However, if you do it with sums and numbers, it will be very easy and the process will flow through very seamlessly. Now, if I look at a 14-mark question, that will typically be a consolidation question. On an average, one question in the descriptive side would take around average 2 minutes, in which case, over here, MCQs happen fast. So, it's a 180-mark paper, out of which I would say MCQs of 30 marks will happen relatively faster. Maybe, I can say around 30 to 35 minutes, and hence you are going to be left with around 140 or 150 minutes for a descriptive section, which will lead you to around approximately 2 minutes per mark, approximately, and hence I would say that consolidation of 14 marks should get over in 28, at max 30 minutes. Out of those 30 minutes, the first 10 to 12 minutes will go in reading the question, then preparing a Schedule 3 format, then preparing the notes, then preparing working note 1, 2, 3, then reaching working note 4 where you are doing analysis. You will take at least 12 minutes to reach this stage. It's a direct process. No concept, you just apply the process. Then from minute number 12 to minute number 20 approximately is where you will apply all your understandings. You will give effect to the adjustments. You will give the 2 effects wherever required. And after the 20th or 22nd minute, depending on how complex the question is, then you will again, once you have the analysis of the profits, you will post the numbers from working note 4 to working note 1, 2 and 3, do the totaling and casting, then again total the notes, then again take it to the balance sheet, and by 28th minute, it will get over. So out of the 28 minutes, I would say at least the first 12 minutes as well as the last 6 to 8 minutes, that's close to 20 odd minutes approximately, is a direct process which you have to master if you do pen and paper. Practice properly, and then within the remaining 6 or 8 minutes in the middle, there will be a set template of around 7 or 8 adjustments, out of which 3-4 adjustments are usually asked by the institute, which you have to apply. And that's it. 14 marks are in your pocket. Okay, so from now on, we will not be afraid of consolidation. We'll actually treat it as one of the more scoring areas. So over here, there are a few common adjustments that we would want to discuss. But before that, it's best if we try to apply this through a few sums. So let us go to question number 1. Again, we have written the last day revision questions at the top, and along with every question you will see. But over here, if I go to question number 1 quickly, just to understand what we have discussed, we will do it in a slightly longer format where we can find, based on our regular working notes or steps, how to find these answers. From the following data, determine in each case the minorities at the date of acquisition, and then consolidation. This is date of acquisition is DOA, date of consolidation is DOC. A goodwill or a capital reserve, and then the amount of the holding company's profit in the consolidated balance sheet, assuming the holding company's own profit and loss is rupees 2 lakhs in each of the cases. So there are 4 separate cases and you need to find this. So over here, basically, minorities is typically your working note 3, goodwill is typically your working note 2, and consolidated reserves is typically your working note 1. So this is a question where you're going to practice nothing but applying these working notes. So you'll have working note 1. In each of these cases, you'll start with 2 lakh rupees. You'll start with standalone parent. Then you leave around 4 or 5 lines. Then you go to working note 2, that is goodwill working. Goodwill working, you will start for 90% stake. Your cost of investment is 1,40,000 minus your share in the net worth as on the date of acquisition, that is 1st of January 2016. Today, the date of consolidation is 31st December 2016. So over here, we will say that, well, the share capital, well, over here remains the same. Generally, in every question, your share capital will not change unless the question tells you other way around. So over here, for this share capital of 1 lakh, you will say out of this 1 lakh, 90% is attributable to the parent and 10% is attributable to the minorities. So when we do this working, I would probably have, if I look at question number 1, case 1, 2 lakhs to start with, then out of this share in net worth, 90,000 is attributable to the parent, 10,000 is attributable to the minorities. Okay, now what are you left with? Sir, we are left with profit and loss, which is 70,000. However, on the date of acquisition, it was 50,000, which means, can I say, if I prepare a format, opening is 50, closing is 70, there is no dividend, and hence 20,000 is a profit during the year 2016. That is assumed to be post-acquisition profit. So if I go to see the split, out of this 70,000, 50 is pre, 20 is post, and hence this is 50 and 20. Now this 50 and 20 is to be analyzed, out of which 90% is attributable to the parent, 10% to the minorities. So this is 45 and 5, 18,000 and 2,000. Now out of the 45,000, where will this go? This is parent share in the pre-acquisition profits. I would have purchased it by making an investment, and hence it will go in working note 2 for goodwill workings. Whereas when I look at 18,000, this is what parent has earned during the post-acquisition period, and hence this is 18,000 over here. Okay, then you have 5 and 2,000. This will go in minorities, which will be, for example, 5,000 and 2,000. And hence this is going to come to 17,000. Okay, so what do we want to do? Well, now we have, for example, your total consolidated reserves of 2,18,000. That is 2 lakh standalone plus 18,000 parent share in the post-acquisition profits of the subsidiary. Then you look at the goodwill workings, 1,40,000 you have invested for getting your share in the net worth on the acquisition rate of around 1,35,000, and hence 5,000 will be goodwill. And for minorities, as on the acquisition date, 10 and 5, that is 15, and later another 2,000 is earned, so that is 17. So if you practice a little more, if I go to case B, 85%, 1,04,000 is your investment, and 30 and 20. So there is a 10,000 loss post the acquisition. If I do the attribution in my goodwill workings, I will start with 1,04,000. Parent share will be 85%, that is 85,000 over here. 15,000 will go in the minorities, and then 30,000 is their pre-acquisition into 85%. That is 25,500 will come over here, and the remaining 4,500 is attributable to the minorities. Further, if you go, you will have, for example, out of the remaining post-acquisition losses of 10,000, 8,500 of losses going to the parent, and remaining 1,500 of losses going to the minorities. And hence, 90,500 minorities as on a date of acquisition will reduce by 1,500, comes to 18,000. And this process will continue. So basically over here we are trying to find the values in each of the 4 cases. We've discussed the first 2 cases, the other 2 cases you can also review. There's nothing different over here. If the investment is greater than your share of the net assets or net worth, there's a 5,000 goodwill. If your investment is 1,04,000 and the share of net worth is 1,10,000, then there is a 6,500 capital reserve. If you had acquired 100% stake, like in case D, then your minorities will not be there. Is everyone clear? Okay. So this is your basics regarding how do you determine your goodwill, minorities, or your consolidated reserves. Okay. Now if you look at a few special cases, one by one, if you look at common adjustments, first there is negative minorities interest. Now, like we did case B, where you had your share of the losses. 19,500 was a minority, out of which you subtracted 1,500 and hence you came down to 18,000. However, did your minorities become negative? No. Can your minorities become negative? Well, yes, provided there's a huge loss. Like for example, there was a company which had 100 rupee share capital and 900 P&L balance. That is 1,000 of net worth. It had another 2,000 of loan and 3,000 worth of fixed assets. Now, as of now, my minorities would be having a 10% share of 100 and 900, that is 10% of 1000, that is 100. However, if the asset gets destroyed by fire, there's a loss by fire of 3000. Loan is still there, but there's a loss by fire of 3000, and hence my equity share capital is 100. My profit, which was opening 900 minus 3000, will be a negative 2100. And hence, if I try to find the minorities interest, while my minorities interest will now be negative. Post acquisition, there's a 3000 loss, of which if there's a 10% stake, there's a negative 300. And hence opening minorities of 100 minus a negative 300 comes to a negative minorities of 200. Can the minorities interest be negative? The answer is a loud and clear no. Why? Because of the limited liability concept, where the minorities will say that, well, you know what, after my minorities become 0, if you show a negative, that is a debit balance in minorities, that means that the company will call money from the minority holders and they will have to pay. However, as per the limited liability concept, the minority holders will say that beyond my paid up value or face value, I'm not supposed to pay anything else, and hence the minorities are not going to give you anything else, and hence you will restrict the minorities interest to a 0 balance. However, if the company assumes a going concern, sometimes what happens is the parent keeps on running the company, and hence whatever is the share of the losses of the minority has to be borne by someone. Well, it will be borne by the parent. Like if your opening minority was 100, during the current year there's a 300 rupee loss, then my closing minority becomes a negative 200. Well, I will restrict it to 0 balance, and this negative 200 will be taken up by the parent. So if there's a 3000 loss into 90%, maybe 2700 was to be a loss borne by the parent. Now 2700 plus 200, that is 2900 of loss will be borne by the parent, and 100 will be borne by the minorities. Now later, is it possible that the tide can possibly turn? Yes. Now when the tide turns and the parent starts making profit, let's say the parent makes a 500 rupee profit, can I attribute the entire 500, 90%, 10% to parent and minorities? No. The parent will now say that, well, I have borne your share of the losses. So till that time, your share of losses are knocked off. I will take up your share of profits as well. So out of 500, 90% goes to the parent. The remaining 10%, that is 50, should have gone to the minorities. However, that will go to the parent. So out of the 200 loss borne, 500 is adjusted, and hence only the accumulated loss borne till now is 150. In the next year, another 5,000 is earned. Ideally, out of 5,000, 90%, 4,500 will go to the parent. The remaining 500 should go to the minorities. However, there is still 150 yet to be adjusted. So 150 will be adjusted, and hence the remaining 350 will be taken to the minorities. So over here they say minorities interest refer to the share in the subsidiaries, assets attributed to the shareholders other than the parent. Sometimes the subsidiary might have huge losses, in which case the total balance of minorities becomes negative. Minorities interest cannot be negative because of the limited liability concept, would not require the minorities to pay anything beyond the paid up value, or face value rather. In such cases, minorities is restricted to nil, and the share of losses of the minorities that they don't bear is attributable to the consolidated P&L of the parent. In the subsequent years, in case a minority makes profits, first, the losses that have not been borne by the parent on behalf of the minorities will get adjusted, and any profits beyond that will be allocated to the minorities. Are we clear with this? Remember, Due to post-acquisition profits or losses, minorities will keep on changing. Goodwill or your cost of control as on the date of acquisition, once determined, will remain the same. Now, based on that, there is a very specific question. I think question number 4 over here, which is specifically for the purpose of this minority adjustment. You can actually mark it as important as well for your last day revision, because if this comes, this is the only question which will come on these lines, and it has even come in one of the papers. So let us review this. H acquired 70% of the equity share capital of S on 1st of January 2011. This is your date of acquisition at a cost of 5 lakhs. This is your purchase consideration or your investment. When S had an equity share capital of 5 lakhs and reserves and surplus of 40,000. So over here, if I had to find my cost of control, I would say that the investment is 5 lakhs or 500,000 minus your share in the net worth on 1st of January. On 1st of January, equity share capital was 5 lakhs into, can I say 70%, which is 350, and within minorities interest, the remaining equity share capital of 30%, which is 150 will come. Similarly, over here, you will have the pre-acquisition P&L, which is 40,000 into 70% will come to what? 28. And minorities will also get a share in the pre-acquisition P&L, which is 40 into 30% comes to what? 12 probably. Okay. Both the companies follow the calendar year as the accounting year in the 4 consecutive years. So these are subsequent years. So right now, maybe you have done enough working so that you can calculate, for example, goodwill and the minorities as on the very first day. So over here, this will be what? 378 500 minus 378. This is going to be 122. So your goodwill will be 122 and this is 162. So as on the very first day, 1st of January, your goodwill will be 122, whereas your minorities interest will be 162. Are we clear with this? Yes. So if I were to review this and later figure out why is this changing, well, why would this ideally change? Well, this will ideally change if, just a second, if I can find this question somewhere. Yes, this will ideally change if question 4. This will ideally change if your minorities will change. If your profits change, cost of control will remain the same. So this is 1,22,000 as we said, and on the acquisition date, your minority is coming to 1,62,000. Now, why will this 1,62,000 change? They say in the 4 consecutive years, S performed badly and suffered losses of 1,25,000, 2 lakhs, 2,50,000 and 60,000 respectively. These are all losses. Thereafter, in 2015, S experienced turnaround and registered a profit of 25,000. In the next 2 years, that is 16 and 17, again recorded profits of 50 and 75 respectively. Show the minorities interest and cost of control at the end of each year for the purpose of consolidation. Can I say 1,22,000, which is your cost of control, remains the same. However, minorities interest will keep on changing. Well, so will your consolidated reserves, but consolidated reserves have not been asked over here. So if I go to see, in the first year, I've suffered a loss of 1,25,000 into, can I say 30%, that is 37,500 is attributable to the minorities. 1,62,000 opening mein tha, plus 32,500. Can I say this will be 124,500? So this is 162 minus 37,500 is 124,500. Further, in the next year, there's a 2 lakh rupees. Now, 2 lakhs into 30% comes to 60,000. Your opening was 124,500. Still, I will bear the loss of 60 to come to 64,500. Further, now if I go opening balance is 60, 2,50,000 into 30% comes to 75,000. Now my opening balance is 64,500 minus 75,000 and hence 10,500 is a negative balance. Can my minorities be negative? No. It will be restricted to nil and hence 10,500 of these losses will be borne by the parent. So the losses of the current year that is borne by the parent is 10,500 and the cumulative losses borne till date is also 10,500. In the next year, there's a further loss of 60,000 into 30% will come to around 18,000. Now, opening balance is 0. I will not bear any of this 18,000 and hence your closing balance is also 0. So this is 0 and 0. In fact, the entire 18,000 will have to be borne by the parent. Earlier, the parent had borne 10,500, another 18,000, and this will become 28,500. Now, S registers a turnaround and earns 50,000. Now, out of this 50,000 into 30%, 15,000 is attributable to the minorities. Hold on. 25,000 and not 15,000. 25,000 into 30%, that is 7,500 is attributable to the minorities. Now, I cannot give it to minorities because parent का हमारे ऊपर उधार है, and hence this 7,500 will be taken up by the parent out of the 28,500, and hence you will be left with around 21,000. Next year, as you can see, there will be a further profit of 50,000 into 30% will come to 15,000. Still parent का हमारे पास 21,000 का उधार है. The entire 15,000 will be adjusted over here, and still a remaining 6,000 is there. And lastly, 75,000 into 30% comes to what? This will come to 22,500. However, only 6,000 is to be adjusted towards the parent, and the remaining 16,500 will be the minority interest. Are we clear with this? So this is how your entire journey would appear in such cases. So this is a special adjustment when it comes to negative minorities. So next we'll go to the fair value adjustments. Now these are arguably the most important adjustments when it comes to consolidation in your syllabus. So when we look at the fair value adjustments, why do I need to do a separate adjustments for these fair value adjustments? Like you study for AS 14, even for AS 21, when you acquire control over, let's say, the business, you will take over assets and liabilities. But these assets and liabilities will be taken over at fair value. Remember, you might have a subsidiary where there is a land worth 100 rupees whose fair value is 500. And you might pay a consideration of 500 to acquire this stake. Now, merely because you are acquiring shares, does that mean subsidiary has to revalue the assets in his own books? No. In its own books, subsidiary still continues its separate legal existence, and hence it will keep on recording land as per AS 10, maybe PP, that is at cost model. However, if I consolidate the assets and liabilities, if I take over the assets at 100, let's say the net asset net worth is 100 and my consideration is 500, it will appear that 400 over here is like the goodwill. But is it correct to show 400 as goodwill? Am I extra paying 400 because of the reputation of the subsidiary? No. I'm extra paying 400 because the land of the subsidiary itself is worth 400 rupees more. And as a result, I will recognize the land at 500, in which case my investment with my share of net assets or net worth will be worth, for example, 500 and 500, and hence there will be no goodwill. So I will have to take over in my consolidated accounts the assets and liabilities at fair value. However, the problem is the subsidiary in its own individual records would not have shown these assets and liabilities at its fair values. In fact, the subsidiary would have shown these assets and liabilities at its respective carrying values. Now the thing is, after the acquisition date, there can be a possible depreciation as well. Like for example, when we look at land, there is no depreciation, but for building there may be a depreciation. For example, over here the life of the building is, for example, 10 years, in which case in the later year after the acquisition, the subsidiary would have recorded the building at 100 in its individual accounts, would have depreciated it by 10 rupees, and hence in the profit calculation I would have deducted the depreciation of 10. However, its fair value is 500 and 500 ka 10 1/10 will be 50. So if in my consolidated accounts I am taking over the land and building at fair value is 500, the depreciation later should also be based on 500, that has to be 500 divided by 10, that is 50, and hence the additional depreciation of 40, that is 50 minus 10, that is equal to 40, will impact the post acquisition profit calculation. So when you calculate the post acquisition profit, it will be calculated, for example, as your 50 minus 40, 50 minus 10, that is an additional 40 will be impacted. So at the date of acquisition, as compared to what your net assets or net worth is as per books, as on the date of acquisition, the net worth or net assets has to be increased by 400. Your entry will be land account debit to, let us say, the pre-acquisition reserves. Sir, why pre-acquisition? Because this appreciation has already happened up to the date of acquisition, and hence the fair value change will always be treated as a pre-acquisition reserve. On the other hand, when we look at, let us say, the depreciation impacts the periods after the date of acquisition, and hence the additional depreciation will be a post-acquisition reserves adjustment. Now you can credit a separate revaluation reserve, fair value reserve, or any reserve. At the end of the day, the reserves have to be analyzed, and hence institute over here adjusts all of these effects against the P&L only. Because if it is a pre-acquisition reserve, in any case it will go to the goodwill working, and the minority share will go with minorities. So there is nothing in what name you use. Institute usually adjusts these fair value adjustments against reserves. So the long story short would be, if on the date of acquisition, if there is a fair value adjustment, it can be upward or it can be downward, then whatever is the change in the fair value, you will adjust it against your asset. So building account debit, for example 400, to the pre-acquisition reserves 400. After that, you are not preparing consolidated balance sheet today, you are preparing it after 1 year. During that 1 year, the subsidiary would have depreciated the building by 10 rupees, though it should have been depreciated by 50 rupees, and hence an additional 40 has to be deducted. However, that will be deducted from the post-acquisition profit of the subsidiary. And hence, these are your typical fair value adjustments. So over here, we say as per AS 21, assets and liabilities should be taken over at fair values on the acquisition date. In case fair values are not given, then the book values can be used to be the same as fair values. But if the fair values are separately given, we will need to take fair values at the time of consolidation. It is because it is not mandatory for the subsidiary to revalue its assets in its standalone books merely because the parent is attributing higher or lower value. Subsidiary is continuing its separate legal existence. When the parent acquires the stake, it is just a change in the register of members. Therefore, unless specifically given, we would always assume that the subsidiary has not revalued the assets in its standalone books. However, in the consolidated accounts, the assets have to be shown based on the fair values on the acquisition date, and hence the following adjustment needs to be done. How will I do? Let's say for BP, initially, whatever is the difference between the fair value and WDV, if it is an upward movement, PP account debit to pre-reserves, downward movement, pre-reserve account debit to PP. Subsequent, the impact on depreciation, this is depreciation based on fair value and depreciation based on WDV. Additional or reversal as the case maybe, if there is an additional depreciation, post-reserves account debit to PP, if there is reversal, PP account debit to post-reserves. The general rule is initial change in fair value will always be adjusted against pre-reserves, whereas any subsequent change will be adjusted against post-reserves. Are we clear with this? Okay. Next you have unrealized profits on intercompany transactions. This is also an important adjustment. This is if there are two types of transactions where parent sells to the subsidiary goods of 100 at 120, so profit of 20 is recorded in the books of the parent. Subsidiary has recorded stock of 120 which is unable to sell. Now in a consolidated balance sheet, the stock will appear at 120 and parent's profits will appear at 20. However, out of that 120, 20 is unrealized profit and hence it needs to be eliminated. Earlier P&Ls were different, now they are one and the same, and hence P&L of the parent, which is in working note number 1, account debit to inventories. Inventories should be shown at cost. For the group, the cost is 100. Inventories are at 120, so you will adjust it. So over here, inventory adjustment, if it is downstream, profit of B, which is in working note 1, to inventory. As the unrealized profits are in the books of the parent, there is no need to bifurcate between pre and post or between parent and minorities because it is in the books of the parent. The problem arises if it is in the books of the subsidiary, which is an upstream transaction. If subsidiary were to sell inventory of 100 at 120, there's a 20 rupee profit and the parent's books have inventory worth 120. Now, this profit of 20 would have arose in the subsidiary's books when, depending on the date of sale, you will classify it between pre and post. If the sale had happened after the date of acquisition, it is post. If it had happened before the date of acquisition, it is pre. If nothing is given, we will assume that this is in the post section. Okay, so profit of P to the inventory. Okay, profit of P to the inventory. As the unrealized profits in the books of the subsidiary, we need to allocate between pre and post. If the date is not given, we'll assume that the sale happens in the post period. This is a typical ICI assumption. Now, a similar understanding will also apply if the sale happens at a loss. Pre-acquisition profits are eliminated, the unrealized profits are eliminated, so are the unrealized losses. They will also be eliminated. And this will also apply if there's an upstream or downstream sale of PP. even over here, the unrealized profits will be eliminated. But over and above that, over and above the unrealized profits to be eliminated, you will also eliminate over here the effects due to additional or lower depreciation. So if asset of 100 is sold at 120, in the books of the recipient, the depreciation would have been based on 120, and hence where the depreciation over 10 years would have been 100 divided by 10, that is equal to 10. Here it is 120 divided by 10, that is equal to 12, and hence the 2 rupees of additional depreciation will need to be reversed. Now, before we go on to dividend, we will do a couple of questions over here which are linked to this fair value adjustment. So over here, if you go to, let's say before that, if you go to question number 6, not a very important question, quickly referring this, A holds 80% of the equity capital and voting power of B. A sells inventory costing 180 lakhs to B at a price of 200 lakhs. A is selling to B, which means this is downstream. The entire inventories remain unsold with B at the financial year end, that is 31st March 2009. This is downstream. So over here, the profit of 20 needs to be eliminated. Your entry will be P&L of A account debit to, let us say, inventories. Loosely speaking, this is 20. A holds 75% of capital of B and A purchases inventory. A purchases inventory, which means B is selling the inventory, costing 150 lakhs from B at a price of 200 lakhs. So there's a 50 rupee profit. The entire inventories remain unsold with A at the financial year end, and hence this will be, I think, 200 minus 150. This is equal to 50. So your entry will be P&L of B account debit to inventory. Such is the accounting treatment for the above mentioned transactions in the consolidated statements of A, giving a reference to the relevant standards. Now remember, out of these profits of B, I can say 75% of the profits are attributable to the parent and 25% of the profits are attributable to the minorities. That is in the second adjustment. In the first adjustment, when it is downstream, the entire adjustment is to be done against the profits of the parent only. Are we clear with this? Okay. Next, you will go to question number, I think, okay, I would say we will go to question number 10. I think there is another question as well behind which is similar to this, but question number 12 or 15. 15 I think is very similar. I have written over here. Question 13 is similar to question 8. Question 15 is similar to 10. So we'll try question number 10, and then 15 you can try on your own. Before that, if we go to question number 16 and 17, these are basic questions. We'll try to review them. Now, A acquired 70% equity shares of rupees 20. A acquired 70% equity shares in B at rupees 20 per share with a face value of rupees 10 on 31st March 2021 at a cost of 140 lakhs, which means 140 divided by 20, I must have acquired 7 lakh shares. Calculate the amount of share of A and minority interest in the net assets of B on this date. Okay, so maybe 70% will be attributable to A, 30% will be attributable to the minorities. Also compute the goodwill or capital reserve for A on the acquisition of shares of B with the following information available from the balance sheet of B as on 31st March 2021. Remember, the acquisition happens on 31st March 2021 and you have also been given the position of the net assets on 31st March 2021. So you'll have the PPE, investments, current assets. You are assuming these are loans and advances which are given. 15% debentures and current liabilities. Now usually you have data regarding net worth as on the acquisition date. Here you have data regarding net assets. So what? So we will take that, and this probably comes to around 340. So we are saying that 340 is the net assets. Out of this 340, can I say 70% is a parent share and 30% is minority share, and hence I will get 340 into 70%, which is 238 and 102. So they are asking you how much will be the minorities interest. We will say minorities interest is probably going to be 102. However, if I want to calculate the goodwill or capital reserve, I will say whatever is my PC or investment, it is 140 minus my share of the net assets or net worth, which is 238. And hence if I do this, you will have 238 and 140 difference निकालेंगे. I think this is 98, which is negative, and hence this is a capital reserve. It's a fairly easy question, but it is looking at net asset as a base rather than net worth. Next, you have question number 17. Long acquired 60% stake in short for a consideration of 112 lakhs. On the date of acquisition, short's equity share capital was 100 and reserves was 40. And the balance in the P&L was 30. So total, if I look at my net worth, it will be 100 plus 40 plus 30. Can I say it will be 170? If this is my net worth, unless given otherwise, it will also be my net assets. Now from the above information, you are required to calculate the goodwill or the capital reserve in the following situations. So you are supposed to calculate the goodwill or capital reserve in the following situations. First, on consolidation of balance sheet. Second, if long showed investment in subsidiary at the carrying amount of 104. And if the consideration paid for acquiring 60% stake is 92. So if I go to see my share, if we see over here, my share in the net worth would be 60% of 170. 170 into 60% comes to, I think, 102. So in all the three possible cases, case number 1 on consolidation, I'll compare 112 with 102. There is a 10 rupee goodwill. Next, if I'm showing at 104 minus 102, there would be a 2 rupees goodwill. And last way, 92 with 102, I'll show a negative 10 capital reserve. Are we clear with this? Okay, now before we go to the slightly bigger questions, I will go to the homework section so that you are a little more comfortable in your consolidation process in terms of the balance sheet. You don't really need to refer this, but otherwise a smaller question if I can touch upon so that it gives you a bit of comfort on preparing the consolidated balance sheet. Just a second, if we go to question number, I think 12. It's an exam question from November 2022, but this is now focusing on the Schedule 3 balance sheet. Now, H and S provide the following information as on 31st March 12. Okay, so what is there? H and S provide the following information as on 31st March 12. PP investments, 14,000 shares of S. Current assets, share capital, fully paid shares of rupees 10 each. So this is probably 2 lakh, 3 lakhs. This is, can I say, 20,000 shares of rupees 10 each. Profit and loss, trade payables. This is as on 31st March 2022. Now, H acquired shares in S on 1st July 2021. Okay. The balance of profit and loss of S on 1st April 2021 was 60,000 and prepared the consolidated balance sheet of H and its subsidiary as on 31st March 2022. So if I go to see over here, what is your date of acquisition? 1st July 21. And what is the date of consolidation? 31st March 2022. Now if I look at H stake, this is 14,000 out of 20,000. And I say that is a 70% stake. And hence minorities interest will be 30%. Now, these are the facts of the case that you generally note down in the beginning, these 4 points on what is a DOC, DOA, parent stake and minorities. After that, you can prepare the Schedule 3 balance sheet. So when you are preparing the Schedule 3 balance sheet, over here you will have the shareholders funds, then reserves and surplus, share capital, no non-current liabilities, directly current liabilities having trade payables. On the assets you have PP, a separate line item you will leave for goodwill. And then you will have current assets. That's about it, a tiny balance sheet. Then you will note down all assets and liabilities. Now, after that, you will have to prepare a working note 1. This working note number 1 over here will be pertaining to your assets and liabilities. Let me see if I can find this. Question 12 of the homework question. As you can see over here, this is the data that you have done. Then you prepare the consolidated balance sheet as we discussed. And then you have notes to accounts where you take the share capital, which is the share capital of only the parent. 30,000 shares of rupees 10 each. Then each and every asset and liability, H and S, trade payables, no adjustment, no adjustment, no adjustment. You don't total up anything right now, you will total up at the end. However, you will write down over here. Then you have working note 1. In working note number 1, you will start with the standalone balance of the parent, which is 1 lakh. For profit and loss, there is no other reserves, so that is about it. Then you go to working note 2, which is investments. You'll start at 2,52,000. This is your investment. Working note 2, 2,52,000. Then you take your share. In the share capital, 70% of 2 lakhs, 1,40,000 over here, 60,000 in minorities. And then you come to the crux of the question where you will attribute the profits. Now, when you look at the profit attribution, today there is 80,000 profit and loss in the subsidiary. On 1st April 2021, the balance was 60,000. Can I say that means 20,000 must have been earned during the year? So 60,000 is on 1st April 2021 and hence it is clearly pre. But during the year 20,000, you'll have to segregate. The first 3 months are pre. So that is 5,000 is pre and the remaining 15,000 is post. So if you go to see over here, segregation of 20,000 between 5,000 first 3 months and then the last 3 months. So there is no other adjustment upstream, downstream, fair value, nothing is there. So this is 65 and 15. Out of that you will do maybe 70-30, 70%, 30%, 70%, 30%. 45,500 will go in the goodwill workings because this is your share in the pre-acquisition profits. 10,500 will go in the consolidated P&L workings. 10,500, 45,500 and that's about it. Then the remaining 2 items will go in the minorities, 19,500 and 4,500. And after that, you will total up the consolidated reserves, 1,10,500, goodwill of 66,500 and minorities. These numbers you will take as it is, like over here, reserves would be 1,10,500, goodwill will be 66,500 and minorities will be 84,000. Without exaggeration, typically this will account for at least 2/3 of the marks of your question. If you get these 3 numbers right, even if your balance sheet does not tally, you don't have to worry. Other than that, you will then total up every other item. Take trade payables 3,20,000, 4,60,000, 2,88,000 and hopefully your balance sheet should tally. Is everyone clear with this? Yes. So this is a general run through of the question from your homework section. Now we'll again go back to the questions from your classwork section where we are going to discuss question number 10. Now earlier there was a question number 15 which is in a way a subset of question number 10. That is, if you have done question number 10 properly, then 15 automatically gets done. We will review that. So over here you look at question number 10, mark it as important. The following is the balance sheet of H and S as on 31st March 19. So you have the balance sheets given for H and S. And there are 16,000 shares at the rate rupees 20 each. Okay, 16,000 shares, if you go to see, are out of 20,000 shares of 10. And hence, can I say there is an 80% stake? 16,000 on the base of 20,000. 20,000. H acquired 80% of shares on 1st April 18. DOA, 1st April 18. On the acquisition, general reserve and profit and loss stood at 50,000 and 30,000 respectively. So this is as on the acquisition date, the reserves. And hence, if you were to call this as 0.1, let's say the effect over here will be for 0.1. Machinery with a book value of 2 lakhs and furniture with a book value of 40,000 of S were revalued at 3 lakhs and 30,000 respectively on 1st April 18 for the purpose of fixing the price of the shares. The rates of depreciation computed on the base of useful lives are 10% and 15%. This is a fair value adjustment, 0.2. Will impact the PP. Over here, this is the machinery. This is furniture. I guess this is, I think, yeah. Just a second. I think there are some changes over here. This is 6,40,000 and I guess this is 1,80,000 over here. Then this is coming one line above, 375 and 34. So the furniture over here is 3,75,000 and furniture over here is 34,000. Sorry. So over here this is the case. Trade payables of H include 40,000 due to S for goods supplied since the acquisition of shares. So there's an intercompany trade receivable, trade payable adjustment, and these goods are charged at 10% above cost. The inventories of H include the goods costing 55,000, which is a cost to H, Purchase from S. So this is an unrealized profit on upstream sale. This is upstream because I think S has sold goods to H. You're required to prepare the consolidated balance sheet along with its subsidiary as on 31st March 19. Now, how do I start this question? I will first figure out what my date of acquisition is, which is at the start of the year, 1st April 2018. I'll figure out what my date of consolidation is. That is 31st March 2018. 1 year has gone by. And I'll figure out what my stake is, that is 80%, and minority stake will be 20%. Then I'll prepare the format of the Schedule 3 balance sheet and write down all the assets, all the liabilities. Then you will go to working note number 1. In working note number 1, in a columnar form, you will show the reserves of the parent, which is 4,35,000 on the general reserve, 2,80,000 on the profit and loss. Then you will go to working note number 2, which is on investment, where you will show investments appearing at 3,20,000. And then you will attribute the share capital of the subsidiary, which is 2 lakhs, I think 80-20, 1 lakh 60, and I think 40,000. So if you review this, I believe this is question number 10 over here. As you see, 1st April 18, 31st March 19, 80 and 20. Prepare the Schedule 3 balance sheet. Write down all the notes. Wherever you see that there are any adjustments, leave around 3 to 4 lines. If you're not very sure, leave 3 to 4 lines in every item. उसमें क्या problem है? Then you look at working note number 1, 435, 2 lakh 80. Investment 3 lakh 20, as we have written over here, 3 lakh 20. And share capital of 1 lakh 60 to the parent, 40,000 to the minorities. And now you are going to do the analysis of reserves. When you do the analysis of reserves, you will first start with the general reserve. Now, when you look at the general reserve, you have been told that the general reserve stood at 50,000 and P&L stood at 30,000. These are the opening balances. So, as you can see, 50,000, 30,000 over here. Then you look at the closing balances. Your closing balances would be 155 and 65. 155, 65, which means the balancing figure is 105. There is a profit earned during the year. Now, out of this profit, the entire profit is in the both section because the date of acquisition is 1st April 18. In the earlier sum, the date of acquisition is in the middle of the year and hence you had to attribute. Here, you don't need to do that. So, over here, the entire 50 is pre, the entire 105 is post. Out of this 35, the entire 30 is pre and the 35 is post. However, there are a lot of fair value adjustments and hence, once you do this attribution, there is no dividend, but there are fair value adjustments. First is on machinery. So, if I go to see, you have machinery with a book value of 2 lakhs and furniture with a book value of 40,000 revalued at 3 lakhs and 30,000 respectively, which means machinery is going up by 1 lakh, machinery account debit 1 lakh, furniture is going down by 10,000 to furniture 10,000 and hence there's a net 90,000 change in the net assets and thereby the net worth as on the date of acquisition and hence it is a pre-acquisition adjustment. So what we do is we leave around 8 to 10 lines and then we pass journal entries. Institute does not pass entries. You may not pass it in the exam, but if you're not very clear, entries really help you. So you'll have machinery account debit 1 lakh to furniture 10,000 to, well, this is a fair value adjustment in the pre-acquisition profit, it's 90,000. You'll give effect for everything. So when I go to the notes on machinery, I will say initial fair value adjustment plus 1 lakh. In furniture, initial fair value adjustment minus 10,000. And for this 90,000, I will usually adjust the P&L, 90,000 increase and this 90,000 will come over here. So over here, this will be your adjustment. Now the problem is, this was on 1st April 2018. Now you're on 31st March 19. So my depreciation for machinery, which was I think 10%, based on the book values, the rate of depreciation was 10%. So this they would have done 2 lakhs into 10%, that is 20,000. But based on fair value, it will be 30,000 and hence there will be 10,000 additional depreciation, which will go in the post-acquisition section. Similarly for furniture, they would have depreciated 40,000. Into 15%, that is 6,000. Ideally, it should be 30,000 into 15%, that is 4,500. So there is a 1,500 reversal of depreciation. So if I go to see over here, additional depreciation will be post P&L debit 10,000 to machinery 10,000 and reversal of depreciation will be furniture account debit. You will increase the furniture to post P&L and hence you will give the effects. Post P&L will be debited. Okay, furniture mein post P&L will be credited. And the second effects will in turn go over here. 10,000 will reduce from the machinery and 1,500 you will add to the furniture. Okay. So that takes care of the fair value adjustment. Then trade payable, trade receivable, whatever is the 40,000 balance, you will directly adjust. Mutual indebtedness or mutual owing, ट्रेड रिसीवेबल्स में से 40,000 हटा देंगे एंड ट्रेड पेबल्स ऑल्सो यू विल सबट्रैक्ट 40,000. आर वी क्लियर विद दिस? अच्छा, next you will look at unrealized profit in stock. Over here there is a 55,000. The inventories of H includes goods costing 55,000, cost to H, that is the selling price to H, supply purchase from S, and these goods were charged at 10% above cost. So if 100 was the cost, 10% is the profit. This is 110. Therefore 55,000 divided by 110 into 10 comes to 5,000. And hence over here this is 5,000 over here. So this is upstream, so this is profit and loss of the subsidiary account debit, assuming in the both section, to inventories. So if I look at the upstream adjustment over here, this is P&L of subsidiary to inventory, and as a result P&L of subsidiary in the post section you will subtract, and the second effect will go in the inventories. This is unrealized profit downstream. This is 5,000, and with that you have taken all the adjustments, and once you take all the adjustments, now it is just casting 50 and 1 lakh 5, 1 lakh 20 and 21,500. If I do 80-20 percentage over here, you will see this. If I mark this in, let us say green, 40 and 96 coming in the goodwill working, and then let us say if I mark this in red, 84 and 17,200 going in the consolidated workings. Everything else you can see going in the minorities, and you will total up 99,300. You have a 24,000 goodwill and 5,19,000 and 2,97,200 for the reserves, and with that you can drop the balance sheet, and that should tally at 25,25,500. Now once you review this, you will find that your question number 15, which is a subset of this question. So if you do 10, you don't need to do 15, but in your first revision, you can probably try both of them. Like with the balance sheets of H and S on 31st March, reserves and P&L are given at 25 and 15,000 respectively. 80% stake is acquired. Machinery with a book value of 1 lakh, furniture with a book value of 20,000 were evaluated at 1 lakh 50 and 15,000 respectively. As you can see, machinery is going up, furniture is going down on 1st April 10, and the depreciation rates are 10 and 15%. Exactly the same, just that I think in question number 10 हमने सब कुछ into 2 करके रखा हुआ है. Here that is not the case, and you have the entire balance sheet. There is no other adjustment, there is just the fair value adjustment. In fact, the same adjustment is there in 10 along with a trade payable, trade receivable adjustment, unrealized profit on upstream adjustment, and hence that is something that you should ideally try to revise. Okay, so that takes care of question number 10 and a similar question 15 as well. Okay, next, before you proceed, you will go to the next adjustment, which is the adjustment for dividend. Now this is the next important adjustment for you. Now this is a fairly tricky adjustment, okay? So when you look at dividend, you need to kind of borrow some of your understanding from AS 13, Accounting Standard 13 on investments. Now dividends may be paid out of the pre-acquisition profits, and if they are pre-acquisition dividends, that is paid out of profits earned prior to the date of acquisition, then as per AS 13, pre-acquisition dividend should be, you guys tell me, should be reduced from the cost of the investment. However, if it is post-acquisition dividend, that is dividends from profits after the date of acquisition, then the dividend should go to the P&L account. Now, if the company had correctly done the adjustment, that is, if the company received, let's say the holding company received the pre-acquisition dividend and it credited it to the investment, then there is no other adjustment needed. There's no rectification needed. Or if the dividend was paid out of post-acquisition profits and the company took it directly to the P&L account, then there is no rectification needed. However, the problem will arise when? The problem will arise where the holding company erroneously took the pre-acquisition dividend to the P&L account. In this case, your parent company's P&L is overstated and investment is wrongly stated, and hence you will have to give a rectification effect. The rectification effect over here is the P&L of the parent account debit to investment, and because this is going to go into the investment, it will impact the goodwill as well. So over here, if we try to pull that up somewhere, if you have made a chart for this, so when you look at dividend in the books of the parent, if I pull up this chart and I say in the books of the parent, Dividend can be out of the post-acquisition profit of the subsidiary. Now, ideally, if it is out of the post-acquisition profits of the subsidiary, it should be credited to the P&L. If it is credited to the P&L, then there will be no rectification needed. And PS credited to the P&L, then there is no adjusting entry needed. Everything will automatically be adjusted. However, this is a more important thing, where dividend is out of, let us say, post-acquisition profits, and you have credited to the investment. So this is an error which needs to be rectified. In which case, over here, it should have gone to the P&L, is credited to the investment. So investment account debit to P&L would be the rectification entry, investment account debit, or cost of control account debit to P&L. Investment goes in working note 2, that is a goodwill. Cost of control. And if dividend is out of pre-acquisition profits and PS credited the investment, well, it should have been credited to the investment. If it is not credited to the investment, that is when rectification. If it is credited to the investment, then nothing else is required. No adjusting entry needed. But if it is credited to the P&L, and what I've written in red is the most common thing that the institute does. It says that dividend is out of the pre-acquisition profits and it ends up crediting the P&L. However, it should be credited to the investment. So investment or cost of control will be credited and the P&L of the parent in working note number 1 will be debited. Now this is a rectification adjustment that needs to be done. If P has credited the pre-acquisition dividend to the P&L account, then investment or cost of control, as a case maybe, will be credited and P&L of the parent in working note number 1 will be debited. All of this will be to the extent of P's share of dividend, and that's about it. If you are able to get this correctly, well, you are able to solve for dividend adjustment properly by and large. Okay, so over here, if you review a few questions to see the application of your understanding for the dividend, let us say you go to question number 2. Question number 2. XYZ Limited purchased 80% shares of ABC as on 1st of January 16 for 1,40,000. That is your investment amount. The issued capital of ABC as on 1st January 16 was 1 lakh and the balance in the profit and loss account was 60,000. Okay, this is the profit as on 1st January 16. Remember the stake was also acquired on 1st January 16. Profits may be earned after 1st January 16. These are post-acquisition profits. If nothing is given, we generally assume that the dividend is paid out of the profit of the respective year. So if it is dividend of the year 2016, it would be paid out of the profits of 2016. If it is dividend of the year 2017, would have been paid out of the profits of 2017. But if it is dividend of the year 2015, then it must be paid out of the profits of the year 2015, irrespective of when the dividend was actually paid. Now, during the year 31st December 16, ABC earned a profit of 20,000 and at the year end declared a dividend of 15,000. Now, are you told that this dividend is out of which profit? Well, if it is declared for the year 2016, it must be out of the profits of the year 2016, that is 20,000. This must be post-acquisition profits. Show by an entry how the dividend would be recorded in the books of XYZ. Who is receiving this dividend? Well, the entry would be bank account debit. They would receive this dividend, and ideally, since it is out of post-acquisition profits, they will be crediting it to the profit and loss account of XYZ. Okay, what is the dividend amount? Well, 15,000 hai, dividend out of which XYZ would receive 80% and hence probably 12,000. What is the amount of minorities interest on 1st of January 16 and then on 31st December 16. Fair enough. Also check whether there should be any goodwill or capital reserve at the date of acquisition. So if I look at goodwill or capital reserve as on the date of acquisition, over here we will have the goodwill workings. Let us say for goodwill workings you will have investment of 1,40,000. To this you will have your share in net worth. Share in the net worth. Well, I will have equity share capital, 80% of 1 lakh, that is 80,000. Remaining will go in minorities. Equity share capital, 20,000. Okay. Then you will have reserves, profit and loss, 60,000. So this is pre-acquisition. P&L. Remember, no dividend is distributed out of this. So 60,000 ka directly, if I take 80%, this comes to I think 48,000. And pre-acquisition P&L of 12,000 will come over here. Okay, so this will give you the minorities as on the acquisition date. I think 32,000, this is the minorities. And if I take 1,28,000 over here, this will probably give me a 12,000 goodwill. this will probably give me a 12,000 goodwill. Okay. So there will be a goodwill. Yes, this will be 12,000. And they are saying what is the minorities on 1st January on 31st December. Now on 31st December, if I go to see, if I do my analysis of the profits, just a second, if I go to question number 3, यहाँ पे आ गया. Let's say if I go to question number 2, it should be done somewhere over here only. I think it's a basic question, we would have done it directly. So over here, I would have said that this is in the post section 20,000, out of which less 15,000, and hence 5,000 is still remaining. Out of this 5,000, 80% will go to the parent, 20% will go to the minority, and hence 1,000 will go to the minority, and hence 33,000 will be the minority's interest at the end of the year. So here we are saying that the profits of the year 2016 would be used for paying dividend of the year 2016. These are post profits. Dividend is paid out of the post profits, and hence it should go to the P&L account. Are we clear with this? Yes. Okay. On similar lines, you'll have question number 3. Now, EXC Limited acquires 70% of the equity shares of Z Limited as on 31st March 2017. Okay. At the cost of 70 lakhs. The following information is available from the balance sheet of Z also on the same date, 31st March 17. Perfect. So this is on the same date. Fixed assets and everything, last mile loans and current liabilities are liabilities. The following revaluations have been agreed upon, not included in the above figures. Fixed assets go up by 20%. So this is plus 20%. And hence can I say this will be 144. Investments down by 10%, which means this will be 49.5. Okay. Z declared and even paid a dividend of 20% on its equity shares on 31st March 17. Let us say over here you say that the face value is rupees 10 per equity share. EXC Limited purchased the shares of Z at rupees 20 per share. Now, how many shares are there and what will be the dividend value? So over here, if I look at 70 lakhs divided by rupees 20 per share, 70 divided by 20 comes to, I think, 3.5 into rupees 10. So this will be your face value, 35. This is total number of shares and their face value into dividend is 20%. So into 20% comes to what? 7. Now this 7 has been declared and paid on 31st March 17. So can I say this is on the date of acquisition? So this must be declared and paid out of what? Well, this would be out of the profits on up to the date of acquisition, let us say 16-17, which means is this dividend out of pre-acquisition profits or post-acquisition profits? Well, this would be out of pre-acquisition profit surely, because you are on the date of acquisition, you have not even earned a single rupee of post-acquisition profit. And hence this is out of pre-acquisition profits. How much is the dividend? 7. And hence over here, if you go to see, they had said further that, where is this? Okay. Purchase the shares at rupees 20 per share. Calculate the amount of goodwill or capital reserve as on the date of acquisition. Now you can do this by comparing the investment with the share in net assets. If I go to the share of net assets, 144 plus 49.5 plus 70 plus 15 minus 90 minus 50, and hence this comes to 138.5. This comes to 138.5. Now if I compare the investment, what is the investment? 70 minus 7, and hence can I say this is equal to 63. Why? Because this is pre-acquisition dividend, and pre-acquisition dividend will be reduced from cost, and hence this is 63 compared with my share in the net assets, which is, I think, 138.5 into 70%. If I have done this correctly, into 70% will be 96.95. And hence, if I take the difference over here, there will be a capital reserve of around 33.95. Similar questions are also there in the study material. So over here, the only additional adjustment is for the adjustment of that pre-acquisition dividend, which should have correctly, like in question 2, it should have gone to the P&L. Well, we have taken it to the P&L because it is out of the 2016 profits. In question number 3, Because it is out of the 16-17 profits, it must be a pre-acquisition dividend, and hence I should subtract it from the investment, which is what we have done. Okay, next we have question number 5. Now H acquired 3000 shares in S at a cost of 4,80,000 on 31st July. So the date is relevant over here. 3000 shares at 4,80,000 on 31st July 16. The capital of S consisted of 5,000 shares. So maybe 3,000 and 5,000. Maybe we have acquired a 60% stake of rupees 100 each, fully paid. The profit and loss account of this company for the year 2016 showed an opening balance of 125, and profit for the year was rupees 3 lakhs. What was the opening balance? 1,25,000. Profit for the year was rupees 3 lakhs. So if I go to see on a totality basis, I will have 125 plus 3 lakhs. Now, at the year end, it declared a dividend of 40%. Now, this is a 40% of the total value. So this is 5,000 into 100, that is 5 lakhs into 40%. Can I say this is 2 lakhs? So I would have declared 2 lakhs worth of dividend. Now, this must have been from the profits of the current year. Okay. Record the entry in the books of H in respect of the dividend. Assume the calendar year is the same as the financial year. Now, the problem over here is that the dividend is 200 out of 300. So I can say, okay, 125 is pre-acquisition. Out of this 300, I cannot say the entire 300 is pre-acquisition. This is 300 profit for the year, but the date of acquisition is 31st of July, which means, can I say 7 months? Over here, profits are pre-acquisition, 5 months are post-acquisition. So if I do 300 into 7 divided by 12, probably 175 of my profits are pre-acquisition and 125 of my profits are post-acquisition. If dividends are out of this 300, then can I say dividend follow the same pattern? So over here, out of the 200 into 7 by 12, can I say around maybe 116.67, and 200 divided by 12 into 5, 83.33. Okay, this is on a totality basis. If I had to do analysis, now in this particular case, I will say that as H, how much dividend am I receiving? 3,000 into 100 into, I believe, how much dividend am I receiving? 40%. So this is 3,000 into 100 into 40% comes to 1,20,000. Now out of the 1,20,000, can I say for the first 7 months, this dividend is out of the profits of the current year. Out of the current year, 7 by 12 is pre-acquisition, and hence 70,000 is pre-acquisition, whereas 5 by 12 is post-acquisition, and hence 50,000 is post-acquisition. So if I had to pass the journal entry, my journal entry over here would be, for example, if I put it over here, just a second, my journal entry would be bank account debit. Let me write it in blue. Bank account debit 1,20,000 to investment. I have to pass the correct entry only. 70 to P&L. Let us say 50. Are we clear with this? Yes? Okay. So this takes care of question number 5 and maybe some bits of your understanding pertaining to dividend. Well, 7 is on consolidated P&L. 8 is on changes on accounting policies, which we are yet to do. Let us see if I were to review question number 9. Now, this is an important question where we have put this as important for your last day revision. Where you have the dividend adjustment, fair value adjustment, a lot of adjustments are there over here. There's also some preference shares over here. So we'll see what is to be done with the preference shares. So let us review question number 9, please. So let us review this. The summarized balance sheet of X and its subsidiary Y as on 31st March 17 are as follows. So you have the balance sheet. Over here, the important adjustment is there's a preference share as well. But remember, preference share at the end of the day are also shareholders. Like the treatment over here will be very similar to the equity shares in the subsidiary. Well, equity shares in the subsidiary which are held by the parent go into the goodwill working, which are not held by the parent go into the minorities. So if there are preference shareholders, which are owners basically of the selling company, but the parent has not acquired any stake in preference shares, then will go to minorities. If there are preference shareholders which are acquired by the parent, then the investment will be investment in equity shares and investment in preference shares, and the corresponding preference share capital will come along with the goodwill workings. So we'll see that. But the institute has not yet asked you anything material regarding preference shares. Then you have all of this land and building, furniture, investments in Y. This is 450 lakh equity shares in Y, purchased on 1st of April 2016. So the date of acquisition is 1st April 2016. If I look at the share capital over here would be, I think 6,000, which is basically, I believe, 600 shares of rupees 10. And hence, if I look at my date of acquisition, date of consolidation, then H stake is 450 on the base of 600. 450 on the base of 600 comes to, I think, 75%, and the remaining is held by minorities, 25%. In preferences, the entire 100% is held by minorities unless given otherwise there is some investment. Date of acquisition is given to us over here at 1st April 16, and date of consolidation is a 1 full year later, that is on 31st March 17. Okay, so these are 4 pointers that you will note at the beginning. Following is the information also given to you. 10% dividend on equity shares was declared by Y on 31st March 16. This was declared on 31st March 16 for the year ended 31st March 16. Now, this must be paid out of the profits of the year 15-16, and that is pre or acquisition. X credited the dividend received to its profit and loss account. Is that correct? No. I will have to make an adjustment. So, over here, there will be a P&L of what is this company? X, account debit to the investment. You have wrongly credited to the P&L, but what is the dividend amount? It is 10%. Achha, how much dividend would I have received on 450 shares into rupees 10? That is 450 into 10 comes to 4,500 into, can I say 75%? 450 into 10 into, so that is 4,500 into 10%. 450 is the total dividend. Just a second. 450 into 10, 4,500 into 10%. I think 450 hoga. Or you can take the total dividend, which is 600 into 10 into 10%, 600 into 75%, 450, that is right. So over here, P&L account debit to investment, this is 450 at each of these levels. So ultimately, from this, you will subtract the 450 in your working note number 1, and in your investment, you will subtract from this 450 from your working note 2. Okay, then the credit balance of the P&L on 1st April 16 was 650, and the general reserve balance stood at 1450. That is fine. You are just given the opening balances. Plant and machinery showed a balance of 4,000 as on 1st April 16. At the time of purchase, X revalued plant and machinery upward by 1,000 lakhs. So your entry will be plant account debit, let us say 1,000 to the pre-acquisition P&L, because this is as on the date of acquisition. So this is plant increasing by 1,000, and second effect going in the pre-acquisition P&L. Ajay, is there anything given regarding the depreciation? Not over here, but does that mean that I will ignore the depreciation? So over here, when we look at the depreciation, we can say that in my books, the machinery was 4,000, which is now becoming 3,600, which means during 1 year, 400 must have been the depreciation. So can I say approximately 10% rate? Now, even if I go to 4,000 plus 1,000, that is 5,000, into 10%, that is a 500 rupees. And hence, can I say additional depreciation will be 100 rupees? Sir, how did you calculate it? We don't have the rate of depreciation. Yes, but I do have the carrying value. The carrying value over here is 4,000 and this is 3,600. So during the year, there is a 400 rupee depreciation, and that is 10%. Okay. And hence, on the additional amount, also there will be an additional depreciation of 1,000 into 10%, that is 100 rupees. So you can say there is an additional depreciation of 100. Included in trade payables of Y are 50 lakhs for goods supplied by X. So this is trade payables में से 50 you will subtract, and also in trade receivables over here you will subtract 50, for example. Okay, this is done. On 31st March 17, Y's inventory included goods of 150 lakhs which it had purchased from X. So this is downstream. And X sold the goods at cost plus 25%. So which means 150 into 25 upon 125. Can I say this is equal to 30 rupees? Yes, so this is going to be reduced from the P&L of the parent because it is downstream, and second effect will go against inventory. You are required to prepare a consolidated balance sheet and of X and its subsidiary as on 31st March 17, giving working notes, ignore dividend on preference shares. So over here, if I go to question number 9, we have by and large discussed the entire theory based application. So if you review question number 9, as you can see, 1st April 16, 31st March 17, 75% stake, 25% held by the minorities, and 100% of preference share is in minority. Now I'll prepare the Schedule 3 format like I usually do, then write down the notes. Within the notes, you'll have equity shares as well as preference shares of the parent. Both of these are parent shares. Then in reserves, and then you look at all of these adjustments, and where required, you will leave some space. Then you will go to your regular working notes where you will start with the working note 1, standalone X. Okay, then there is some pre-acquisition dividend as well, which is reduced over here, and second effect is going against investment. You are reducing it over here. Then you look at share in the equity share capital, 4,500 and 1,500. The important thing over here is minorities will include preference shares as well. 100% of the preference shares will be at 1,000, and that will give you a full picture. For example, for minorities, at this stage you will go to the reserves. Within the reserves, general reserve, you have 1450 at the start, and I guess even 1450 at the end. So if I look at the general reserve, 1450, you have been told 1450 at the start, so there is no change. P&L is 650 at the start, and it is 1250 at the end. So if I go to see in the P&L, 650, 1250. Now during the year, there was a dividend of I think 600 being paid, but this must be paid out of the opening balance because it is paid out of the profits up to 31st March 16. So this is dividend out of the pre-acquisition profits. You will deduct it from the pre-acquisition column, and then whatever is the balancing figure, well, because the acquisition date is at the start of the year, the entire balancing figure is post. Now you will get the breakup of 50 and 1200. However, you cannot directly attribute it because there is a fair value adjustment. So this is well, you have given effect to this rectification entry, and then there is plant account debit to pre-P&L. So this is pre-P&L increased, and then in the plant also you will increase. Further, there is an additional depreciation of 100 which is subtracted from the post-P&L. Further, there is a downstream transaction, but downstream transaction directly goes over here, unrealized downstream of 30, and that's about it. Once you do all of this, whatever numbers you get, 75-25, 75-25. If you pose these numbers properly, you will get a capital reserve of 25, a non-controlling interest of 3,400, and these are your reserves. So when your reserves are general reserve 2,500 plus profit and loss 3,095 plus a capital reserve of 25, and hence this will come to 5,620. Other than that, you will have trade payables by mutual indebtedness. In this, you will have fair value and additional depreciation. Unrealized profit on downstream will be subtracted over here, and in trade receivables also mutual indebtedness. And that's about it. So with this, your balance sheet would tally at around 30,643, but this is your regular process. And this takes all the three core adjustments that can come in a question. You will have dividend, you will have unrealized profit on upstream or downstream, and then the fair value adjustment. If you are able to do question number 9 properly, by and large, you should be in a good position for most of the tricky consolidation problems. Okay, so that takes care of question number 9. 10 is already done. If I review question number 11, I would say 11 is also similar to question number 9. So if I do question number similar, in fact, it is an easier version of question 9, and then homework question 12. Here the acquisition is happening somewhere in the middle of the year. So if you review question number 11, I'm just discussing this. We have A acquired 1600 shares of rupees 100 of B on 1st July. This is the problem. You are acquiring somewhere in the middle of the year, 1st July. On 31st December, the summarized balance sheet is given below. There is 1600 shares. And you have the summarized balance sheet. These are 2 lakh. That is 2,000 shares of rupees 100 each. So 1,600 divided by 2,000, can I say that is an 80% stake, and 20% stake is held by NCI? The regular balance sheet. And then you have profit and loss of B, showed a balance of 30,000 on 1st January 16. Date of acquisition is 1st July 16. Out of which a dividend of 10% was paid. Is it as clear as it gets? On 1st August. So is the dividend out of pre-acquisition profits or post-acquisition profits? So it is out of pre-acquisition profits, because this is dividend which is paid out of the balance on 1st January 16 and your date of acquisition is 1st July 16. Now A has credited the dividend to its profit and loss. So this is an error. Ideally this should have been reduced from the investment. A has a 80% stake. So if I look at my total dividend, this is 2,000 or 2 lakhs is my total share capital into, I think, 10%. So this is 20,000 of total dividend and 80% is my stake, and hence this is, I think, 16,000. I've credited 16,000 wrongly to my P&L. So I will credit the P&L. If I can find this question number, I think kya hai 11. I'm not sure where this is. Again, this is more like a practice question. Yes, question number 11, 80%. You have the Schedule 3 balance sheet. You do this regular format and everything. And here you have the adjustment for the pre-acquisition dividend, which is wrongly credited. This will be 16,000 over here, and your investment will also reduce by 16,000 over here. Okay. Next, the plant and machinery, which stood at 1,50,000 on 1st January, was considered worth 1,80,000 on 1st July. Can I compare 1,50,000 and 1,80,000? The answer is no. Sir, we did that. Yes, but that is because in every other date, these were at the same date. 1,80,000 is a fair value on 1st July. However, if I do 1,50,000, this is a value as on 1st January. I need to find the WDV on 1st of July. This figure is to be considered while consolidating the balance sheets. Rate of depreciation on plant is 10%, which means I think 7,500, 15,000 for the entire year, 7,500 for 6 months, and hence 142,500 will be your PPE, which if you compare with 1,80,000 minus 142,500 will be 37,500 of a fair value adjustments. As you can see over here, your fair value adjustments would be 37,500, and a second effect of that will also go in your P&L pre-acquisition 37,500. Now, if I want to find the additional depreciation, 1,80,000 into 10% into 6 by 12, that will be 9,000 as compared to 7,500. So 1,500 will be my additional depreciation, which I will have to deduct. So I can see over here 1,500 in the post period and 1,500 also deducted from here. Okay. And hence that will help me with the fair value adjustments. The challenge over here would be that since you have been given the PP balance of 1,50,000 at the start of the year, with 1,80,000 at 1st July, you'll have to compare fair value and WDV on the same date, that is 1st of July. Okay, next, there is nothing else. There's no other fair value adjustment, no other upstream, downstream, nothing else. So the thing that you have to remember over here is when you do this working, well, if nothing is given, we'll assume that the general reserve at the end of the year is the same as the general reserve as the start of the year. Alternative assumption is possible. But when you look at the dividend, your opening balance was 30, out of which 20,000 was paid. And the closing of it is 82, then during the year 72 must have been earned. But that 72 for the calendar year would have been 36 and 36. Split. This is where a lot of students make a mistake. And hence, based on that, you will do the evaluation like we did in the earlier problem. That kind of takes care of this working. After that, the regular postings, etc. is something which is done in a similar way. You need to practice the balance sheets on your own. At least for one of these questions, I would say on your own. You can try question number 9 on your own. We have discussed this, but in a proper flow, and hopefully that should give you better clarity. Okay, now with this, you are going to be left with a few specific adjustments, which are bonus, which are for uniform accounting policies, which are for consolidated profit and loss preparation, which we will do on the other side. Okay. So we'll go to the next part of consolidation and complete the remaining few adjustments which are remaining. So we have completed about the process of consolidation, and then a few important adjustments like the fair value adjustment, upstream or downstream sale of inventory adjustment, as well as the pre-acquisition dividend adjustment. Apart from that, one very common adjustment that Institute likes asking largely independently is the adjustment involving uniform accounting policies. Now, usually parent and subsidiary are two separate legal entities, and hence they can follow different accounting policies. Like parent can follow FIFO for its inventory, whereas subsidiary can follow weighted average, for example, for its inventory, which is absolutely fine in their own individual records. However, if the same type of inventory is consolidated, then can the same inventory be consolidated as per different accounting policies? The answer is no. You need to follow uniform accounting policies for the purpose of accounting, and as a result, when you follow these uniform accounting policies, then there may be certain changes, and these changes over here would be reflected in the form of a consolidation adjustment. Like, what are the examples of different accounting policies? It is possible that parent follows VIVO, subsidiary follows weighted average. Then you will have to restate the subsidiary's financials as per the parent's policies. So, for example, the closing stock of the subsidiary is 100 as per weighted average. As per VIVO, the stock would have been 120, and hence you will increase the closing stock. So, if your closing inventory increases in the balance sheet, the second effect has to go somewhere. Now, if the closing stock goes up, all else remaining constant, that means your COGS falls, and thereby your profit increases, and hence there will be an increase in profits, and hence the second effect will go in the profits. Now, there can also be an effect in the opening stock. Now, the problem is the opening stock of the current year will increase if it goes from, let's say, 50 to 60. That increases the COGS of the current year and thereby reducing the profits of the current year. However, the opening stock of the current year will also be the closing stock of the last year. And as a result, if your opening stock increases by 10, your closing stock of the last year also increases by 10. And thereby, the last year's COGS will fall, let us say, by 10 rupees. Thereby, the last year's profit will increase by 10. The current year's profit will reduce by 10, and hence the effect will nullify. It's a little difficult to comprehend. However, if you kind of think of it in numerical terms, like closing stock being 100 and 120 and the opening stock at the start of the year being 50 and 60, and try to correlate it, you will realize that the closing stock of the current year will increase the profit of the current year if it increases, whereas the closing stock of the last year will increase the profit of the last year, but the last year's closing stock will become the current year's opening stock, and thereby what that will result into is a reduction in profit of the current year by 10, also an increase in profit of the last year by 10, and hence the effect till date will nullify. Another examples can be for provision for bad debts. It is possible that one of the companies has a policy of creating, let's say, a 1 or a 2% provision for bad debts based on debtors. The other company does not have that. So, for example, the parent does not have that policy, but a subsidiary has that policy. In which case, the subsidiary's debtors are also after deducting a provision for bad debts, but when we consolidate debtors, they have to be based on uniform policies, and hence you will reverse the provision for bad debt. Like, for example, at the end of the year, the debtors were, for example, 990, and that is after a 1% provision for bad debt. So we'll say if your gross debtors were 100, 1 would be your provision for bad debt, and hence your net debtors will be 99. So if 99 is equivalent to 990, then 100 is equivalent to how much? Are we clear with this? And hence that 100 will come to 1000, and hence 10 rupees would be your provision for bad debts, which you will need to reverse. So you will reverse the provision for bad debts in your journal entry will be your P&L would be credited because an expense will be reversed, and your debtors will be debited. So debtors will increase from 990 plus 10 to 1000, whereas the current year's profits will also increase, for example, by 10 rupees. Another very common example over here could have been, let's say, writing off expenses. Like you might have done big advertisement, and hence parent would have said that as per AS 26, that advertisement should have gone to the P&L account. However, in subsidiary, maybe it's a foreign subsidiary where it is allowed to spread over this expense over 3 years, in which case out of the 300 expense, parent would have recorded that in the P&L immediately, but subsidiary would record 100, 100, 100 in each of the years. And as a result, if in the first year 100 is already written off in the subsidiary books, parent would have written off the entire 300. So 200 must be shown as, let's say, something like a prepaid or deferred revenue expenditure, as the case may be. And hence, this 200 would be written off. So prepaid expenses will be credited, and your current year's profit will be debited to the extent, because you need to follow parent's policy and parent writes off everything. There can be various such examples. So institute usually takes these 3 common examples. One is inventory differences, one is bad debts for debtors, and third is this big advertisement expenses. You will have to align the subsidiaries accounting policies in line with the parents accounting policies. One of the effects will be on the balance sheet item like inventory, like debtors, like prepaid expenses. The other impact will be in the retained earnings or the P&L accumulated balance. Are we clear with this? So over here we have, while preparing consolidated financial statements, uniform accounting policies need to be followed for like-to-like transactions in similar circumstances. In case subsidiaries accounting policies are different from the parent, we will need to first restate the subsidiary's balance sheet in line with the parent's policies, and then do the consolidation based on the restated balance sheet. For example, if S follows weighted average, whereas P follows FIFO, then subsidiary's balance sheet will be restated based on FIFO, and that will be used for consolidation. Another difference may be in terms of different reporting dates. Like for example, in India, the reporting date is usually 31st March, but I have a foreign subsidiary where the reporting date is 31st December. So I have the parent's balance sheet on 31st March 2025, but the subsidiary's balance sheet on 31st December 2024. So there is a 3-month gap. So do I need to again prepare the entire finalized accounts as on 31st March 24? Technically, yes. However, the standard understands that it is very time consuming to do accounts finalization, and hence it says that if the time gap is up to maximum 6 months, then what you can do is you can make material adjustments, maybe due to fire, maybe due to some major sale or purchase that have happened in that 3-month period, and you will just incorporate the effect of those material adjustments and find the balance sheet as on 31st March. That is the draft balance sheet of the subsidiary as on 31st March after incorporating the material items that have happened during the 3 months. And then we will use that restated balance sheet for the purpose of consolidation. However, if the gap is more than 6 months, like for example, you look at a company in Australia which might have a 30th June year ending of 2024, and we are now at 31st March 2025. So there's a 9-month time gap. Now you have no choice. You will have to prepare the subsidiary's complete financials and not just for material events, considering all the items during those 9 months, and prepare a 31st March balance sheet of the subsidiary, which will be used for the purpose of consolidation, because consolidation has to happen at a uniform date as well. Are we clear with this? Okay, different reporting dates. The financial statements used in the consolidation should be drawn up to the same reporting date. If it is not practicable to draw at the same date, then these financials are drawn up to different dates. Adjustments should be made for the effects of significant or material transactions that occur between those dates, like 31st December to 31st March. In any case, the difference between reporting dates should not be more than 6 months. If it is, then you have no choice but to prepare the complete financials of the subsidiary for the purpose of consolidation. Now, considering that, if you go to a couple of questions, you will go to question number 8. Based on that, there's an exactly similar question number 13, which has come in the main exams as well. And then Institute also asked a question number 18, which incorporated one of these adjustments in a bigger problem. So let us try to do this working, please. Go to question number 8, please. Over here, subsidiary B provides the following balance sheet. Again, as on 2010 and 2011, the entire balance sheet is there. Then you have the share capital, reserves, and all the notes. Also consider the following information. Now, B is a subsidiary of A. Both companies follow calendar year as their accounting year. So the year ending is 31st December. And this is the balance sheet of subsidiary B. A values inventory on a weighted average basis, whereas B values using a FIFO basis. A uses what? Values inventory on a weighted average basis, whereas B uses a FIFO basis. To bring B's inventories in line with those of A, the value of inventory is required to be reduced by 12,000 at the end of 2010 and 34,000 at the end of 2011. Okay, so this is to bring B's inventory in line with A. Now, if you see at the end, what is asked? Restate the balance sheet of B as on 31st December 11. Are you also asked to restate as on 31st December 10? No. Only 31st December 11. After considering the above information, for the purpose of consolidation, would restatement be necessary to make the accounting policies adopted by A and B uniform? Yes. Restatement is necessary, and you have been asked to restate as on 31st December 11. If you were also asked to restate on 31st December 10, we would have done that as well. Here you have asked to restate on 31st December 11. So you have been told A values the inventory using weighted average, whereas B uses FIFO. That is fine. To bring B's values in line with A, the value of inventory is required to be reduced by 12,000 at the end of 2010. Well, you don't have to prepare anything at the end of 2010, and 34,000 at the end of 2011. So you'll have to reduce the inventory by 34,000, and hence your entry will be something account debit to inventory, 34,000. Now, what will you debit? Well, if inventory, that is a closing stock, reduces by 34,000, if closing stock reduces, COGS increases, and if COGS, that is a cost increases, profit falls. Remember, if my working was 100 plus 1000 minus, for example, 150. So my COGS would have been probably 950. And now if I reduce this by 34, this means this will come to, let us say, 116. This is 100 plus 1000 minus 116. And hence this will come to, I think, 900. I think, what, 1100 minus 116, 984, and hence the COGS increases, the cost increases, the profit falls. And as a result, over here, there will be a fall in the profit. So your retained earnings will be debited by 34. So if I go to see, maybe your inventories at the end of the year will reduce by 34,000. So reduction by 34,000. And when you look at your profits, well, there is only one reserve, that is general reserve, and hence that will be adjusted. Minus 34,000. Retained earnings or general reserve, as the case may be, will be adjusted by 34,000. Second, B deducts 1% of trade receivables as a general provision against doubtful debts. That is what B does. Is it given that A does a similar treatment? No. So we can assume that A does not do that treatment, and as a result, if I go to see, for B, your trade receivables are 891. Now can I say 891 will be equal to, for example, if you go to see 891, this is after everything. Now if at the start of the year 100 was your total debtors, 1% is a provision for bad debt, and hence you are left with 99. If 99 is equivalent to 891, then 891 divided by 99 into 1 comes to, I think, 9, and this comes to 900. So debtor should move up to 900. So your journal entry will be trade receivables account debit by 9 rupees. Now what will you credit? Well, I will reverse the provision for bad debt. I would have debited the P&L when I created the provision for bad debts, and hence I will credit it. So this is retained earnings or a general reserve, as a case may be, created by 9. So over here your trade receivables will increase by 9,000, and so on will your general reserve also increase by 9,000, because your profit must have been calculated after deducting this 9. I'm now reversing it. Next, you will go to point number D. Prepaid expenses in B include advertisement expenditure carried forward of rupees 60,000 in 2010 and 30,000 in 2011, being part of the initial advertisement expenditure of 90,000 in 2010, which is being written off over 3 years. So 90,000 divided by 3 is 30,000 in each year, 30,000 in 2010, 30,000 in 2011, and your that is written off 30 and 30, and hence 30 is yet to be written off, which is shown as prepaid. Similar amount of advertisement expenditure of A has been fully written off in the year 2010. This is fully written off. So ideally, if I'm at the end of 2011, there is till 2011, out of the 90,000, 60,000, that is 30 in 2010, 30 in 2011 has already been written off, but the remaining 30 is yet to be written off. So over here, this is to prepaid expense, and ideally where will the effect go? Well, to the retained earnings or to the P&L or the general reserve, as a case maybe, 30,000. So over here your prepaid expenses will reduce, for example, by 30,000 at the end of the year, and your general reserve will also reduce by 30,000, and I guess that should be it. So if I go to see, my other current assets would be minus 30,000, and hence this will be 18,000. So if I go to see, 742 minus 34 comes to, I think, 7,08,000. 7,08,000. Debtors comes to 9 lakhs, and 18,000 is prepaid expenses. Other than retained earnings will be 7,14,000 minus 34 plus 9 minus 30 comes to 6,59,000. So if I go to see, this is 6,59,000. These are the only things. If I take this, everything else remains the same. There's no other change. So that will give you the restated balance sheet. This is 5 lakhs plus 659 plus 170 plus 494 plus 430 comes to 22,53,000. If you just verify this, 22,53,000, let us just verify this. Question number 8. The important areas over here would be 6,59,000, 7,08,000, 9 lakhs, and 18,000, 22,53,000. Are we clear with this? Other than that, everything that we've written in red over here is the different items. Everything else, as you can see, is going to be exactly the same. There will be no difference. We'll just prepare this restated balance sheet of B as on 31st December 11, which is ready for consolidation. If you had to do it even on 31st December 10, then you will also make the changes in your opening balance sheet, where your inventory will also change. Your closing stock of 2010 your debtors of 2010 will also change and your prepaid expenses will also change. Now one can also have a doubt that why is there no adjustment given for this 12,000? Well, no adjustment is given because this 12,000 will reduce the closing stock of 2010, thereby reducing the profit of 2010. But again, your opening stock of 2011 will reduce and thereby increasing the profit of 2011, and hence the effect of this 12,000 will negate, and hence you don't need to give any further effects. Are we clear with this? Yes. So this is question number 8. You can review question number 8 and then maybe go to question number 13. Now if I go to question number 13, this is by and large a similar question to question number 8 only. So if you have done 8 properly, 13 is kind of a cakewalk. Consider the following balance sheet of M&T. The same balance sheet is given. M&T is a subsidiary of LTC. LTC values inventory on FIFO, whereas M&T uses LIFO. To bring M&T's inventory in line with that of LTC, the value of inventory is required to be reduced by 5,000 at the end of 17-18 and increased by 12,000 at the end of 18-19. Inventory of 17-18 has been sold out during the year 18-19. So basically, the cumulative effect in the year 18-19 is going to be an increase by 12,000. So if my inventory over here increases by 12,000, one effect is 12,000 over here, inventory debit. To the second effect goes in the profit and loss. So when I look at the revenue reserves, this will also increase by 12,000. Okay. There will be no effect of the opening inventory because the effect internally negates. M&T deducts 2% from trade receivables as a general provision for bad debts. So look at trade receivables of 343. 343 is equal to 98. Then 100 is equal to how much? 350. And hence, can I say 7,000 is what I will add on the debtors. And the second effect will go against the revenue reserves. 7,000 added over here. Next, you will have prepaid expense of M&T include sales promotion expenditure carried forward to 25,000 in 17-18, 12,500 in 18-19, being a part of sales promotion of 37,500 in 17-18, which is written off over 3 years. So out of that, I can say 12,500 and 12,500 has been written off in the year 17-18 and 18-19. Still another 12,500 is remaining, which must be in the prepaid. Similar nature of sales promotion has been fully written off in the year 17-18 for the parent company, and hence over here for prepaid expenses we will subtract minus 12,500 and over here also minus 12,500, and that's about it. So I can take 5,05,000 minus 12,000 plus 7,000 minus 12,500. Again 5,05,000 plus 12,000 plus 7,000 minus 12,500 comes to 5,11,500. All else remaining the same. In terms of inventories, 7,02,000. For debtors, 3,50,000. And for prepaid expenses, 52,500. If you take these numbers, everything else remains the same, and hopefully your balance sheet should tally. Restated balance sheet of M&T as on 31st March 19 after considering the information. This was an exam question. Now similar to that, a question number 18 was asked in the recent exams, which we have put for your last day revision. Question number 18. In this particular question, you will have a case of Art and Craft Limited. If you review this question, the balance sheet of Art and Craft as on 31st March 24 is given. So you have the entire balance sheet being given. And then the notes to accounts. Art acquired 3,200 ordinary shares of Craft on 1st October 2023. That is somewhere in the middle of the year. 3,200 shares. वैसे कितने shares है Craft में? 4,000 equity shares. So 3,200 divided by 4,000. Can I say that is an 80% stake? Which means 20% is held by minorities. So at the start of the question, you will mention that Art holds 80% stake, 20% stake is held by minorities. Date of acquisition is 1st October 23 and date of consolidation is 31st March 24. The reserve and surplus showed a credit balance of 40 and 58,700 on 1st April, that is at the start of the year. The plant and machinery of Craft, which stood at 2,50,000 on 1st April 23, was considered worth 2,20,000 at the date of acquisition. This is the fair value. The depreciation on plant and machinery is 10% on the basis of useful life, and the revaluation of plant is to be considered at the time of consolidation. Now, if I look at the fair value adjustment over here, remember 2,50,000 is on 1st April 2023, whereas the date of acquisition is 1st October 2023, and hence there will be a 6-month depreciation. 2,50,000 minus 10% or 2,50,000 into 10% comes to 25,000 into 6 by 12. And I say that is 12,500 of depreciation. So I will compare 237,500, that is a book value, with 2,20,000, which is a fair value. And hence there will be a 17,500 reduction in the fair value. Okay, so there will be an initial fair value adjustment as your pre-acquisition profit and loss account debit to plant and machinery of 17,500. Okay, further there will be also be, if I go to see, just a second over here, you will go through the regular steps in question number 18, 1st October, 31st March, 80% stake, 20% stake, a schedule 3 balance sheet, all the notes, and then you will have this working note 1, 2 and 3. Next, when you go to the analysis of reserves, we will say that we will have to split the reserves between pre and post. So when you split this between pre and post, we will say that the opening reserves are 40 and 58,700. Closing are 40 and 2,08,000. So can I say in general reserve there is no change? 40, it is 40. The entire thing is pre. There is no change. But in the P&L, you started at 58,700 and ending is 2,08,000. If there is no dividend, the difference over here is 1,49,300. But remember, this cannot be fully post, cannot be fully pre, because this is for the year, out of which 6 months is pre, 6 months is post. 74,650, 74,650. Now there will be a fair value adjustment after doing all of this of 17,500, and this is plant and machinery to be reduced by 17,500. Your entry will be pre-P&L account debit to plant and machinery. So over here 17,500 in the pre column, and the second effect goes in the plant and machinery. Over here this will be less initial fair value adjustment. Now due to this, the depreciation will also change. Now your depreciation was 2,15,000 to 10%. For the entire year, that is 25,000. As per books, in the last 6 months, your depreciation would have been 12,500. But if I go to see over here, we will do the working as 2,20,000 into 10% into 6 by 12. Can I say this is 11,000, and hence there will be a 1,500 reversal of depreciation. In the books, you would have recorded a depreciation totaling up to, I think, 12,500 for the last 6 months. Ideally, as per the fair value, depreciation would have been 11,000, and hence there will be a 1,500 reversal of depreciation, that is plant account debit to post P&L. 1,500 plant debit, so this is increased to post P&L, and hence this is 1,500 increase. Okay, nothing new over here, honestly. Point 1 and point 2. Just that be careful that you are acquiring somewhere in the middle of the year. Next, Craft Limited deducts 1% of trade receivables as a general provision against doubtful debts. This policy is not followed by Art. So I'll have to restate Craft's financials to bring it in line with the balance sheet of Art. So when I look at Craft's balance sheet, over here there will be a trade receivables. The trade receivables over here is 1,68,300. What is the general provision? I think 1%. So can I say if 100 minus 1 will be 99, then 99 is 168,300. So 168,300 divided by 99 into 1 comes to 1,700 and upper 1,70,000. So I will have to revise over here and reverse the provision. We assume that the provision would have been created during the year. So your journal entry over here would have been, I believe, debtors account debit to provision for bad debts. So that will be at 1,700. Now we don't know that is 1,700 arising out of which period. Well, you can assume pre, you can assume post, or you can assume since the 12-month period is the entire period. Well, this is out of the debtors during the 12-month period, and hence can I say I will segregate this between pre and post. So I will say 1,700. This is the new adjustment over here, where you will increase the profit by 1,700, out of which 850 is in the first 6 months, 850 in the last 6 months, because this is a charge to the profit and loss over the entire 12-month period. So 850 and 850 will be adjusted over here. Second effect will be against the debtors. So against the debtors, you will increase by 1,700. Okay. And then on 31st March 2024, over here on 31st March 2024, Craft's inventory. Craft, that is a subsidiary's inventory, includes goods which are purchased from Art for 1,03,500, which made a profit of 15% on the cost price. So over here, this is 15% on the cost price. So if 100 was the cost, 15 would have been the profit, and hence 115. So if 1,03,500 is 115, then 15 is how much? Can I say 13,500? But this is a downstream transaction, and hence profit must be in the P&L of the parent, that is Art, and hence P&L of the parent, that is in working note 1 account debit 13,500 to inventory, let us say 13,500. So over here, if I go to see, I will have less unrealized downstream profit of 13,500 to be eliminated, and the second effect will be against inventory. Unrealized profit on downstream of 13,500 eliminated, and that's about it. Once you do that, you have taken care of all the adjustments. You will transfer the profits at the appropriate place. Over here, you will probably get a capital reserve. So 1,20,000 plus 2,40,000 100 plus 13,360 will be your total reserves and surplus balance. As you can see, 373,460, and then your minorities interest will be 1,26,740. You take all of this in your Schedule 3 format to get your final answer. This is just a process. If you are able to take care of those adjustments, this should not be a problem. Is everyone clear? Okay, so this is question number 18. Now 19 over here has some impact. If you go to see of associates, it's a good question from the September 24 paper, but that is, if you have done associates, we can probably discuss this at the end. But if you have not done associates, complete associates and then come back over here. So we'll do the other questions which are remaining, where there is an adjustment pertaining to bonus. So if I go to question number 12, bonus is not as such an important adjustment. Like you have dividend or upstream, downstream or fair value, bonus is not as important. But if it comes, you should be aware. Now usually bonus is capitalization of reserves. If a company gives a bonus, your entry ideally would be reserves account debit to share capital. Like for dividend, we assume that the dividend will be paid out of the profits of the year for which it is declared. Bonus, on the other hand, is usually something which is capitalization of profits, and it is reasonable to believe that the oldest profits will be capitalized first. So whatever are the oldest profits, we will usually capitalize them first, and hence if nothing is given, bonus will be out of the pre-acquisition profits. Remember that if nothing is given, we will always assume that the bonus is paid out of pre-acquisition profits, and if it is paid out of the pre-acquisition profits, generally you don't need to make any further adjustments. You do it in the usual way. Bonus is also like a book entry. It is reserves account debit, reserves belong to the shareholder, to share capital which is also belonging to the shareholder. So as such, it is a book entry. Having said that, if bonus is out of pre-acquisition profits, you don't need to do any adjustments. If it is out of post-acquisition profits, institute does not do any adjustments. It does it in the usual way only. If it is out of post-acquisition profits, it reduces from post, and hence it does the working. In my opinion, that is wrong. But that is there in the study material, even in your May 25 updated version of the study material, and hence we will honor what the institute says and do accordingly. Though we will also say that ideally what should be the appropriate treatment if bonus is out of post-acquisition profits. Though we will ignore that from an exam perspective because the institute also ignores that. Okay. Now, the thing that you have to be careful in bonus is, bonus might increase the number of shares, and sometimes like you calculate stake, like for this art and craft question, you calculate stake as 3,200 which was given in the adjustments with 4,000 which was given in the balance sheet. Now balance sheet was made on 31st March 2024, whereas the 3,200 acquired were given on 1st October 23. Is it possible that later, maybe on 31st December, there was a bonus issue? If there was a bonus issue, is it possible that the subsidiary would have already recorded for the bonus in its balance sheet on 31st March 2024? Yes. So if I compare the number of shares directly with the number of shares in the balance sheet, it might not give me the right answer, because my shares given in the adjustment may be the shares acquired on 1st October 23, on which I will also receive a bonus here. Whereas the subsidiary shares that are appearing in the balance sheet would be at the end of the year, which will already incorporate the effect of bonus shares. And hence, like we will do in question number 12, you need to be extremely careful in calculating the stake, because if you calculate the stake wrong, examiner will not even read the question further. It will give you a direct big zero, because everything is ultimately going to go wrong if your stake calculation is wrong. So you will either take the pre-bonus number of shares which were existing on 1st October divided by the pre-bonus total number of shares on 1st October, or you will take the total post-bonus number of shares on 31st March divided by the total bonus shares in the balance sheet on 31st March. Are we clear with this? Yes. Okay. So this will be the ratio that we will usually take. Further, if there is a dividend in the same question when there is bonus shares, you have to look at the date of dividend vis-a-vis the date of bonus shares. Like if the dividend is given in November, but bonus shares are issued in December, will bonus shares get that dividend? No. But if the dividend is given in, let's say, February, and bonus shares were given in December of the earlier year, unless given otherwise, will those bonus shares also get the dividend? Yes. So we will have to figure out that is dividend entitled on the bonus shares or not. Usually if the date of dividend is on or before the date of bonus shares, then bonus shares will not get the dividend. But if the date of dividend is after, then it depends on the facts of the case, and you can assume that dividend is also given on bonus shares. Are we clear with this? Yes, okay. So we'll review question number 12 on those lines. And over here, there is also some theory. This will be there for bonus shares. Not very important, but in case it comes, you should be aware. For bonus adjustment, while calculating the stake, we should ensure the post-bonus number of shares in the numerator and the denominator. Both of them has to be either post-bonus or pre-bonus. Usually, subsidiary would have already passed the entry for bonus in its standalone books, and hence the share capital would usually be post-bonus given in the balance sheet. The parent need not pass any entry. Bonus का कोई entry नहीं होता in the parent's books or the recipient's books. Other entry for receipt of bonus shares. Okay. However, in the adjustments, you might be given just the number of shares acquired. We will see how that creates a problem. Alternatively, the stake can also be calculated as per the pre-bonus number of shares in the numerator and the denominator. You can either take the numerator and denominator as post-bonus number of shares, or you can take the numerator and denominator as a pre-bonus number of shares. Bonus over here is the capitalization of reserves. We will assume that the oldest profits are capitalized first, and hence we will always assume that bonus is out of pre-profits unless otherwise given. Further, in case there is a dividend along with the bonus issue, we will need to check the date of dividend vis-a-vis the date of bonus issue in order to find out whether a dividend is paid on bonus shares or not. The adjustment, if any, if bonus is out of pre-acquisition reserves, since the share capital, basically you will do the regular working and there will be no further impact, like you will see in one of the questions that we will do. So based on that, if you go to question number 12, on 31st March 17, the summarized balance sheet of H and its subsidiary S stood as follows. So you have the entire balance sheet given. Following information is also provided. H purchased 180 lakh shares in S on 31st March 16 when the balance of the general reserve and the P&L stood at 3,000 and 1,200 lakh respectively. So you have been given the number of shares purchased, that is 180 lakhs on 31st March 16, and the opening balances of general reserve and P&L as on that date. Now on 1st April 2016, that is the very next day, S declared a dividend of 20% for the year ended 31st March 16. Now this is dividend for the year ended 31st March 16, and hence it must be paid out of the profits of the year 15-16. Are profits of the year 15-16 pre or acquisition or post or acquisition? Well, my date of acquisition is 31st March 16, and hence this must be out of the pre-acquisition profits. Now ideally, if it is out of the pre-acquisition profits, then this dividend should be reduced from the cost of the investment. What has H done? H has credited the dividend received to its P&L. Is that correct? No. So there will be a rectification adjustment needed. Okay. On 1st of January 17, S issued 3 fully paid bonus shares for every 5 shares held out of the balance of its general reserve as on 31st March 16. It's very clearly told that bonus is out of the opening general reserve balance. So your general entry would have been general reserve account debit to, let us say, equity share capital. Now on 31st March 17, all the bills payable by S on 31st March 17, all bills payable in S's balance sheet were acceptances in favor of H. So all the bills that S had to pay were technically to H, but on that date, H had only 45 lakhs of these acceptances in hand, the rest having been endorsed in favor of trade payables. Do you understand bills endorsement? Where H would have passed the entry, trade payables account debit to bills receivable, which means now S has to pay to whom? Does it pay to H? No, H has transferred it, negotiated it to some other payable, and hence can I say the remaining bills over and above the 45 which are there in hand are actually payable by S to a trade payable? They may be drawn on H, but since H has endorsed it, the liability of S is to pay to the person who is holding the bill. And hence your intercompany elimination will only be to the extent of 45 lakhs. Other than that, the bills that have been endorsed will not be cancelled because there is an actual liability. Now on 31st March 17, S's inventory included goods which were purchased for rupees 100 lakhs from H, on which H made a profit of 25% on cost. Now this is a downstream transaction. Now we have done multiple such cases where you would say 100 lakhs into, can I say, 25 upon 125, and hence probably this is equal to, can I say, 20 rupees. So I will have P&L of the parent where I will reduce 20 and inventory will reduce by 20. Okay. Over here, your entry will be bills payable account debit 45 to bills receivable, let us say 45. Okay. Now, when you look at bonus and everything, before that we'll have to find a stake. Now, the natural instinct for stake calculation would be you compare 180 lakh with the share capital. Now, the share capital over here, if you go to see, is equity shares of rupees 10 each, and hence 4,800. That is, can I say 480? Can I say 180 divided by 480? Should that be the right answer? 37.5%? The answer is no. Over here, you will say that this is as on 31st March 17. So, will the subsidiary would have already recorded the effect of bonus shares? Yes. So, this 480 shares are already after bonus. However, this 180 shares were what were actually acquired on 31st March 16, that is before bonus. And as a result, can I say I will have to add on this the bonus shares? So I will say 180 was the shares pre the bonus plus the bonus ratio is 3:5. So 180 into 3 divided by 5 comes to 108. And hence this is 180 and 108 comes to 288. So 288 is the number of shares post the bonus. So I can do 288 divided by 480 comes to 60% stake. Or I can find the stake pre the bonus where I can say that 180 was there, on that 108 is issued, which becomes 288. Yahan pe, let us say 480 is there. Now if your bonus was for every 5 shares, 3 shares are given as bonus shares, pre-bonus there were 5 shares, 3 shares will be given as bonus, and hence total will be 8 shares. So 480 divided by 8 into 5. Can I say there must be 300 shares earlier? 180 shares would be given as bonus, and hence I will have 480. I can even do 180 divided by 300 and come to the same 60% stake. So this is something that you need to be particularly careful, especially in the stake calculation. As you can see over here, the stake over here will be 60% either based on the pre-bonus data or 60% based on the post-bonus data. Now we have been clearly told that this bonus is coming out of the general reserve. So how many shares are given out as a bonus share? As you can see, 180 into 10, that is 1800. Now 1800 will be general reserve account debit to equity share capital. Now if I look at my general reserve over here will be 1380 at the end. Starting में कितना general reserve था? 3000. Can I say 3000 में से 1800? 3000 was the opening reserve, out of which 1800 would be adjusted out of bonus, and hence your closing reserve should have been 1200. Maybe it is 1380. So 180 must be the reserves that would have been earned during the year. Okay. So when I go to bonus adjustment over here, when I do the analysis of reserve, I will say 3000. इसमें से 1800 is subtracted. No. Over here I think there is a mistake. This 1800 will be subtracted from the pre-column, and as 3000 minus 1800 will come to around 1200. Perfect. Now the remaining 180 would still remain in general reserve if there is no other adjustment. Now there is also an adjustment pertaining to dividend, but this is pre-acquisition dividend. It should have been reduced from investment, but it is actually reduced from the P&L. So there is an error. Ideally at how many shares? 180 shares. There was no bonus into rupees 10. That is shares with a face value of 1800 into 20%. I must have received 1800 into 20%. That comes to 360. My entry should have been bank account debit to investment. My entry was passed as bank account debit to P&L. So rectification entry would be, you will reverse the income that has been taken in the P&L. So P&L account debit by 180 to investment will be created by 180. So over here, if I go to see, in my dividend 360, pre-acquisition dividend, and similar impact against adjustment, 360, your entry would be P&L account debit of the parent to investment 360. This is also taken care of. Okay, there is no fair value adjustment over here. We have discussed what is to be done with bonus. We have discussed what is done with bills and what is done with downstream. As you can see over here, for bills, I have subtracted mutual owing of 45 from trade receivables, that is bills receivable, and similarly a separate 45 from bills payable within trade payables. Other than that, nothing will be eliminated. For inventories, you can see unrealized profit of 20 and unrealized profit of 20 over here. Further, you still have to see how your profits will be split. Now when you look at your profits, your opening profits, if you go to see, were 1200, closing is around 1620. However, during the year, you would have paid a dividend on the then prevailing share capital of 300 into 10, that is 3000 into 20%. Can I say will be 600? So remember, this dividend will not be on bonus shares because this was paid on 1st April 16 when the bonus shares were not even in existence. And hence, on the then prevailing share capital of 300, today it may be 480, but the then prevailing share capital was 300 into 10, that is 3000 into 20%, that is going to be 600. This is out of clearly pre-acquisition profit. So when I do this working, 600 entirely is out of the pre-column, remaining 600 remains, and the balancing figure of 1020 is entirely post. You will put these numbers, and I think then your working is a standard working where you will calculate a capital reserve of 1320, 2892 and 2947, and then minorities interest as 3120 and prepare the balance sheet. So bonus over here worked in the usual way. Now, honestly speaking, the workings were not correct fundamentally, because what you did is you took the 4800 share capital and did 60-40. So when I look at the share capital, I can say share capital of 4800 into 60% is attributable to the parent and 40% is attributable to the minorities. The problem is, if I were to go as a flashback, on 31st March 2016, was there a 4800 share capital? No, there was only a 3000 share capital, and hence 3000 ka 60% if I go to see would have ideally come to only 1800. So ideally 1800 should have come over here. Instead we have taken 2880. Similarly for minorities, 3000 was the then prevailing share capital into 40%, 1200 should have come over here. Instead we have taken 1920. However, if I go back, then what must be the general reserve existing on that date? Would the general reserve just be 1200? No, the general reserve would have been 3000. Well, bonus is given, but that is given later. So if I were to take a flashback to find the net worth as on 1st April 2016 or 31st March 16, the share capital would have been 3000, but your general reserve would also have been 3000, and hence 6000. Instead, what you are taking is, you are taking the share capital at 4800, that is higher by 1800, the bonus amount, but your general reserve is automatically going down by 1800, lower by the bonus amount. And since both of them are going to go into working note 2 for goodwill workings, the effect negates. As you can see over here, if I go back and see, this is 3000 of my share capital and 3000 of general reserve, that is 1800 and 1800. If I take the total over here, that is going to be 3600, and even over here 3600 only, and hence the effect nullifies. The problem is, if the bonus was out of the post-acquisition reserves. If it was out of the post-acquisition reserves, then what would have happened is, this 1800 over here would have been taken in the post column, for example. And if you subtract it from the post column, then my post-acquisition profits would have been lower. And hence there is an error in my understanding where your goodwill will be wrong, because you are then taking the share capital of 4800 into 60%, and then you are also taking the general reserve of 3000 into 60%. As a matter of fact, if the share capital, if you go back in time, was only 3000 on that date, reserves are only 3000. If you want to take the post bonus setup, then 4800 would have been the share capital, but reserves would have been adjusted to 1200. But if they are out of the post acquisition profits, then reserves would not be adjusted, and hence the effects will be different. In fact, your goodwill will be wrongly adjusted. Your goodwill will change. But can goodwill change after the acquisition date? Ideally, no. Now, Institute, if you look at question 14 or so, has disregarded that and it has changed the goodwill. So, if it comes in the exam, आपको कोई adjustment नहीं करना है. But ideally, this is your adjusting entry. Ideally, over here we have given, this is the situation, ideally, where we can say if bonus is out of pre-acquisition profits, since share capital would be proportionately higher, that is, instead of 3000, 4800, and pre-reserves would be proportionately lower, instead of 3000, 1200. Both which will impact the goodwill workings, the effects will compensate. So there is no further effect needed. But if the bonus is out of post-acquisition profits, then I would say that my share capital will be higher, which will not be negated by my reserves being lower, pre-acquisition reserves, and hence you will pass the entry, well, cost of control or my working note for goodwill workings to the post-acquisition P&L or the consolidated P&L. with the share of the parent. ICAI has ignored it. So I'm not going into too much detail, otherwise you will be confused. If you see the sum which is even there in the study material, which we will do after this, they have ignored this. This adjustment is done to ensure that goodwill is properly calculated, since proportionately higher equity share capital will not be compensated by a pre-acquisition reserves in goodwill working. ICAI has ignored the above adjusting entry, and hence we will also ignore the same. So then why are we discussing this? Because if you believe that that is wrong, I agree with you that is wrong, but institute has not done it, and hence we will also avoid doing it. Bonus hardly comes in the exam, but if it comes, why do you want to go against the institute's trends, which have even been the same in the May 25 exam, in the May 25 study material? Sir, which question are you referring to? Question number 12 did not have this problem. Why? Because the bonus was out of pre-acquisition general reserve. But if I look at bonus coming out of the post-acquisition general reserve, I think question number 14, I can review question number 14, which is pertaining to bonus. And this over here, they are taking bonus. It's also there in the ICISM. Bonus out of the pre-acquisition profits, also bonus out of post-acquisition profits. Let us review this, please. So let us review question number 14. Now on 31st March 11, P acquired 1,05,000 shares of Q for rupees 12 lakhs. 1,05,000 shares. The position of Q as on that date was as under. The PP is given to you, current assets, and 1,50,000 equity shares of rupees 10 each, fully paid. So can I say I have acquired 1,05,000 out of 1,50,000, and thereby that is what? Can I say that is around a 70% stake? Okay, then you have pre-incorporation profits of 30,000, P&L and trade payables. Now P and Q give the information on 31st March 2013. Can I say this is plus 2 years? This is 2 years after the acquisition date. Equity shares for rupees 10 each, fully paid. This is still 15 lakhs. That is 1,50,000 of rupees 10 each. Okay, securities premium, pre-incorporation profit, general reserve, profit and loss account, trade payables, PP, investment is 1,05,000 equity shares of Q at cost. Then you have current assets which are given to you. We have directors of Q. You still have 1,05,000 shares. Directors of Q made a bonus on 31st March 13. That is the very last day of the second year in the ratio of 1 equity share of rupees 10 each, fully paid for every 2 shares held as on that date. Bonus shares were issued out of the post-acquisition profits by using the general reserve. Question very clearly tells you that it is used out of the post-acquisition profits, and this is there in the institute study material still, by using the general reserve. Okay? Now I can say that Q has not yet passed the entry because their equity share capital is still 15 lakhs. So their general reserve is 19 lakh 5. The entry is yet to be passed. Calculate as on 31st March 13 the cost of control or the capital reserve, minorities interest, and consolidated profit and loss in each of the following cases. That is before the bonus issue, immediately after the bonus issue. So this is like working note number 1, 2 and 3 are to be calculated. Now before the bonus issue, things should be very easy. So when I prepare working note 1, I will take all the reserves that are there. So over here, which are the reserves? Securities premium, pre-incorporation profits, general reserve, and profit and loss. I will start with the standalone parent 1, 2, 3, 4. Next, when I go to the goodwill workings, I will start with the investment. Investment over here will appear at 12 lakhs. In start of working note 2, there is no dividend over here. Then we will go to point 3, which is minorities. Now in minorities and in your goodwill workings, we will take the share capital of 15 lakhs. 15 lakhs into 70%. That is 10 lakh 50 will go towards the goodwill working, and the remaining 4 lakh 50 will go towards the minorities. So if you go to see over here, in question number 14, you will start with all of these reserves as we said, 9 lakhs, 0, 60 lakhs, 15, 75. This is before bonus. You will start with the investment at 12 lakhs and then 15 lakhs into 70% and 15 lakhs into 30% will be taken over here. Now you will have to analyze all the reserves. If I go to see, the first reserve is securities premium, nothing is there for the subsidiary. Then you have the pre-incorporation profits, whatever it is, 30,000 was there on 31st March 11, it is also there on 31st March 13. Is it pre or post? So it is pre, and hence इसमें कुछ analysis है नहीं. 30,000 into 70% will directly be taken for the goodwill workings, as you can see over here, and the remaining 30,000 into 30%, that is 9,000, will go to the minorities. Okay, next you will go to the general reserve. Now general reserve is 19 lakh 5. If I go to see on the date of acquisition, there was no general reserve, and hence the entire 19 lakh 5 must have arose after the date of acquisition. So I can say 19 lakh 5 before the bonus into 70%. Can I say 13 lakh 33,500 will be added to the post profit section. So as you can see over here, 13,33,500 over here in the post profit section, and 13 and then the remaining, if I go to see 30%, that is 571,500 will be along with the minorities. Obviously, when you do post bonus, this will be slightly different. When you look at the P&L, the P&L now is 420. On the acquisition date, it was around 60. There is no dividend, and hence the difference of around 360 must have arose in the 2 years after the acquisition. So 60 will be pre, the remaining 360 will be post. As you can see over here, 60 will be pre, remaining 360 will be post. Out of the 60, we will attribute 70%, that is 42,000, remaining 18,000 over here. Out of the 360 into 60%, 252, and the remaining 1 lakh 8 over here, and that's about it. So you will calculate your consolidated reserves, and you will calculate your goodwill and your minorities. Now the question goes further and says that you show us what will happen if there is a bonus. Now, as per the bonus, what will happen is the bonus is in the ratio of 1:2, which means for 1,50,000 shares divided by 2 into 1, can I say 75,000 new shares will be issued, and 75,000 into rupees 10 will be 7,50,000. Abhi 7,50,000 kahan se less hoga? General reserve se. So you'll have 19,05,000 minus 7,50,000, which comes to 11,55,000. So your general reserve that is remaining is only 11,55,000, and your share capital now will not be 15 lakhs, it will be 22,50,000. Are we clear with this? All else remaining constant after the bonus, if you go to see over here, everything else will remain the same. Just that your share capital will now be 22,50,000. ICI has also taken that. And 22,50,000 into 30%. When you look at the general reserve, in general reserve over here, we would say 11,55,000. How did you get 11,55,000? Well, it is your 19,05,000 minus 7,50,000 on the bonus. And hence, you will attribute 11,55,000 into directly 70%, that is 8,08,500 over here, and the remaining, I think 346,500 over here. That's about it. Now, if you take the other items, everything else remains the same, and your goodwill suddenly becomes a capital reserve. ऐसा थोड़ी ना होता. Merely because you give a bonus at a later date, does that mean your goodwill becomes a capital reserve? Fundamentally, that is flawed in my understanding, and the correct treatment ideally should have been, you will pass an adjusting entry of equity share capital account debit, which is there in the net worth, by 7,15,000 to 70%. इसके वजह से हमारा share in net worth is overstated. Earlier, it would have been compensated by a lower pre-acquisition reserve, which is not the case over here. And the credit will go to the post-acquisition general reserve, which over here, as you can see, is understated. Ideally, 8,08,500 थोड़ी ना होना चाहिए. It is 8,08,500 plus, for example, 525. And hence, this is 13,33,350. Though Institute has not done that. And hence, we will avoid doing it. So you will see this working. It is exactly the same as what we did in the earlier case, except for the general reserve balance, which changes, and instead of goodwill, a capital reserve comes. And Institute has safely and comfortably, without any guilt, mentioned that ये capital reserve हो जाना चाहिए. But वो तो fundamentally गलत है. Conceptually, you might think that how can the goodwill change merely because I have given a bonus? I know it does not change. But then in the study material, they have given a sum since time immemorial where it is changing. So we will also have to incorporate the change. So long story short, if the bonus is out of post-acquisition profits, you will do it the way Institute does and not pass this adjusting entry. Unless the Institute comes up with a modification. If it does, we'll put a separate video out. But other than that, you will ignore this adjusting entry and do the working ignoring that. Are we clear with this? Okay. So this takes care of your question pertaining to bonus. Now, there are a couple of other questions, I think, which are there over here on consolidated P&L. Now, largely what we are focused till now is on consolidated balance sheet. However, Institute has also been asking questions regarding consolidated P&L, and trust me, this is a lot more easier working. Like in your profit and loss account, what will be there? Well, there will be revenue, there will be expenses, and there will be profit. Like Assets and liabilities have been 100% consolidated. Incomes and expenses should also be 100% consolidated. So I might be holding 80% stake in the subsidiary. However, because I have the ability to direct the entire activities, and hence I will consolidate 100% of the revenue, 100% of the expenses, I will come to the profit. And actually, institute does not go to that length. However, ideally, after profit is determined, out of that entire combined profit, whatever is the subsidiary's share of post-acquisition profits, of that I will give, let's say, 20% to minorities. But while doing revenue, I will consolidate 100% of revenue, consolidate 100% of expenses, consolidate 100% of the net profit, and then out of that net profit, you will say, out of this net profit, X amount is attributable to the minorities. So over here, I'm not sure whether I've kind of shown an example on this. Let us say, we can take, well, there are a couple of homework questions also, but we can take a standard example for these questions. The only challenge that comes in these questions, again, is a very standardized question which has come multiple times, is there can be intercompany sales and purchase. Like you had debtors and creditors in case of balance sheet. Here you'll have sales and purchase. So you'll remove, for example, the intercompany sales from the sales value, and 100% of that will also be removed from the cost of purchase or cost of materials as a case. Maybe that is one adjustment. There can be some intercompany other operating expenses as well, like consultancy charges, commission income paid by the parent to the subsidiary or vice versa. That may be in other income or in revenue as a case may be, and the second effect will be there in the other expenses. You will eliminate that. And then you might have unrealized profit in stock. Now the problem is, stock over here does not directly go into the P&L. However, in the form of changes in inventory, the stock does go into the P&L. So what I will do is I will try to find the unrealized profit in stock and remove it from the closing stock. Now this closing stock is going to go into the changes in inventory. So if my closing stock was 120, opening stock was 100, then there is a net changes in inventory of -20. Barabar -20. Now, if the unrealized profit was 5, then my closing stock will become 115 minus, let us say, 100, and hence the net changes in inventory will be 15 rupees. So what I will do is I will find the net changes in inventory, the difference between the closing and the opening stock, and then remove the unrealized profit from that to get your final answer. The second effect of this will actually go into the balance sheet, because inventory appears in balance sheet. Earlier, sales was in P&L, purchase was also in P&L, consultancy income in P&L, consultancy expense also in P&L, brokerage income in P&L, brokerage expense also in P&L. However, changes in inventory is in the P&L. The second effect, that is inventory, is in the balance sheet. So the second effect will not be seen. So you don't have to worry, because you just have to prepare the consolidated P&L. Further, there will be some questions where they will be giving you data regarding dividend. Dividend is more like a P&L appropriation. It is not impacted in the P&L per se. It is impacted in the P&L appropriation or retained earnings, and hence in all the questions, Institute has ignored the dividend. Could you have considered it? Possibly yes. However, Institute has always ignored it, and hence we will also ignore the same in all the questions that we will study. Are we clear with this? Yes. So when you look at consolidated profit and loss account, in the consolidated profit and loss account, all incomes and expenses are to be added on a line by line basis, and intercompany transactions should be eliminated from the consolidated figures. So incomes and expenses you add line by line, and whatever is the intercompany items you will eliminate from the consolidated figures. Intercompany transactions include sales or purchase, consultancy given or taken, commission income or commission expense as a case may be. If there's any unrealized profit in inventory, it should be eliminated while calculating the total changes in inventory in the consolidated profit and loss account. Okay, so from the closing stock you can possibly eliminate, or you can just find the changes in inventory, and from that changes in inventory you will eliminate the unrealized profit. You can calculate the changes in inventory as closing stock minus opening stock. Whatever is the changes, from that you will subtract the unrealized profit. Second effect goes against the inventory. So this was one item, this was another item. The statement of consolidated P&L needs to be prepared in Schedule 3 format and will involve consolidating the entire income irrespective of the stake held. Consolidated statement of P&L needs to be prepared up to the stage of profit after tax. Any subsequent adjustment after that date need not be done while preparing consolidated P&L. Attribution to minorities also happens after a PAT, and hence Institute does not show that. So there will be no impact of the minority stake while preparing consolidated P&L, at least as per the ICI solutions. The stake acquired by the parent information is not relevant while preparing the P&L. Ultimately, the PAT will be attributable at a later stage between the parent and the minorities. We need to ensure that only the subsidiary's profit is allocated between the parent and minorities if required. Remember, ICAI does not show that, and hence we will not go into that working. Okay, let us review this. We'll go to a couple of questions in the homework section which have also come recently in the exams for a better understanding. Let us go to question number, I think 12. नहीं 12 हो गया है. Go to question number 13. This is from the exam of May 23. नीचे आप देखो question 14 from the exam of December 21. Let us quickly review this. Now G Limited and its subsidiary K have given the following G and its subsidiary give the following information for the year ended 31st March 2023. Sales and other income. Over here, just a second. Over here you'll probably have to realign the numbers. I think this is not properly given, so sales and other income. Then this is increase in inventories. Then this is raw material consumed. I'm sorry. So this is sales and other income, increase in inventory, raw materials consumed. Then you have wages and salaries, which is 600. Production expenses, which is 100. Administrative expenses over here, which is 75. Selling and distribution expenses, which is 100. Interest, which is 75. And depreciation, which is 75. So there's a bit of matches the following that you'll have to do over here. Okay, once you get done over here, if you just focus on the core things, and you'll do multiple similar questions like this. The following information is also given. G, who is a parent, sold goods with a sale value of 200 to K at cost plus 25%. 1/5 of such goods were still in inventory of K at the end of the year. These sold goods with the sale value of 200 crores. So, like, there are two adjustments over here. Some people just do the unrealized profit adjustment, but remember, in a similar adjustment in the balance sheet, you would have done intercompany elimination of receivables and payables if there were receivables and payables, and then separately done unrealized profit adjustment to the extent of unsold inventory. Over here, sales are of 200. So in my sales working, if I look at question number 13 from the homework section, in my sales working, I will take 3000 plus 750. Can I say minus 200? Okay. And further, in my purchase, well, purchase must be a raw materials purchase, 600 plus 100. From this also minus 200 intercompany. Then there's some unrealized profit in stock. How will you calculate that? Well, this is 1/5 of the goods were in inventory. So this is 200 into 25 by 125. Yeah, but only 1/5 of these goods are there in inventory. So the entire 200 nail in 200 divided by 5, that is 40 into 25 by 125. Can I say this comes to probably 8 rupees? So by 8 rupees, you will adjust the inventory, and the second effect will go against the stock. So when I look at revenue from operations, I will start with G and K, leave a few lines, around 5 lines usually, and then intercompany sales. You will take all the notes, you will prepare the Schedule 3 format of the P&L, blank. Then for every item, you will write revenue from operations, write down for G and K, leave around 5 lines. Every other item, leave around 2 to 3 lines if there is any adjustment, and solve. Next, you will have over here raw materials consumed. Institute within the cost of materials consumed takes the raw materials consumed as well as direct expenses like production expenses. You have raw materials consumed and then production expenses as well. Institute takes this as direct. You could have even taken this in other expenses. You will have G and K, and यहाँ पे minus intercompany purchase of 200 you will remove. Next, you will have changes in inventory. अभी अगर हम देखें यहाँ पे, तो you have been told increase in inventory is already 750 and 100. So this is already increase in inventory. 750 plus 100 minus you will subtract it, and that is a net increase in inventory. If the closing stock is increasing, that your COGS will fall, and hence you will subtract it. So over here, G is 750, K is 100. Closing stock must be higher by 8. You subtract it, and hence 842 over here will be subtracted. Are we clear with this? Okay, we'll do probably another 2 problems so that you are getting clear. Right now we're just discussing. So this is point number 1, a very typical adjustment. Point number 2, G holds 75% of equity share capital of K, and the equity share capital of K is 800 crores as on 1st April 2022. That is the date of acquisition. Does not really matter. 25% is attributable to minorities, but we consolidate 100% of the income, 100% of expenses. We don't need to show the minority allocation, at least in the consolidated P&L. Okay, admin expenses of K include 5 crores paid to G as consultancy fee. Also, selling and distribution expenses of G include 20 crores paid to K as commission. Acha, if these are intercompany expenses, correspondingly there must be intercompany income. Now, ऊपर sales and other income दिया हुआ है, so maybe this will include this commission income as well as the consultancy income. And hence, what I will do is in the other expenses, see for wages and salaries, depreciation, there is nothing. You will do the same working, wages and salaries, depreciation, finance cost comprising of interest, no adjustment. But in other expenses, you will have admin expenses where you will subtract 5. One effect over here. Second effect idhar jayega in your revenue minus intercompany consultancy. Then you have commission, subtract over here. Second effect idhar jayega minus intercompany impact. And that's about it. If you take this is 225. This is your 225 over here. Other items you have directly totaled. Sales you will then finally total and you will get your answer. So basically what you have to do is, in terms of the format, you prepare the schedulery format, revenue, if a separate data is given, then other income separately, then cost of materials. Cost of materials will include the materials consumed, raw materials, and also the direct expenses like production expenses. It is as per ICI solutions over here. Second, changes in inventory, that is increase, closing minus opening up karoge to find increase in inventory. And from that, if there's any unrealized profit, you will subtract it and then get the changes in inventory. Then employee benefit expense, depreciation and amortization, finance cost and other expenses. Within other expenses, you can have admin, you can have selling, where there can be intercompany items. So the expense you will eliminate, and the second effect from incomes also you will eliminate. And that will give you the profit before tax. If a tax data is given, you will subtract and find the profit after tax. After that is done, if you were separately asked, you will then attribute 25% of the subsidiaries post-acquisition profits to the minorities. Here, you are not asked that, and hence we will not do that in line with the institute solutions. Are we clear with this? Okay. So over here, this was question number 13. Now 14 has much bigger numbers if you go to see. Having said that, well, this is again from the homework section. Similar questions. You look at question 13 from homework, question 14 from homework, question 7 or 6 I think from the classwork. They're all same questions. Institute asks you in the same format. Prepare a consolidated statement of P&L for its subsidiary K for the year ended 31st March 23. Okay. Here on question 14, the December 21 paper, Moon and its subsidiary Star provide the following information for the year ended 31st March 21. So you have all this data, equity, share capital. Acha, yahan pe instead of giving you increase in inventory, they have actually giving you finished goods inventory. Okay, so over here if I go to see, this is opening, this is closing. So if I go to see 4200 minus 8575, can I see 4375? This is the net increase in inventory. Similarly 3010 and 3762.5 and 3010. Can I say 752.5? Both of these are increases in inventory. Okay. So यहाँ पे ऊपर दिया था increase in inventory was directly given. Here you can find as closing minus opening. You can always try to do closing minus opening. Then there is dividend income, other non-operating income. This will go in other income section. Other income, other income. Raw materials consumed. This will be cost of materials consumed. Selling and distribution expenses, other expenses. Production expenses, at least institute takes this into the direct expenses. So this will be within materials consumed. Loss on sale of investments, you can either show it as other income minus, or you can show it as other expenses. Either of the case, institute has shown it as a reduction from other income, though more appropriately we can even show it as other expenses, no problem in that. Then sales and other operating income. So non-operating income will be shown separately. This will be revenue from operations. Wages and salaries, employee benefit expenses, general admin expenses, other expenses, royalty paid, other expenses, depreciation and amortization, interest will be finance cost, a standard template. Now on 1st September 18, Moon acquired 50,000 shares of rupees 100 each, fully paid up in Star on 1st September 18. Today you have been given balance sheet on 31st March 21. So the year 2021 entirely, Moon must be holding 50,000 shares. Star paid a dividend of 10% on 31st March for the year ended 31st March 2020, that is for the earlier year, and the dividend was correctly accounted by Moon. Okay, so it must have been taken to the P&L of the year 1920. This is dividend of the year 1920, must have been paid in the year 1920 and would have been taken to the P&L. Institute has no adjustment for this. One can always say कि भाई इसमें कुछ elimination करना है. Institute does not do it, so we will ignore doing it. Now Moon sold goods costing 17,50,000 to Star. Moon sold goods of 17,50,000 to Star at a profit of 20% on the selling price. Inventory of Star includes goods of 7 lakhs received from Moon. So over here, can I say 17,50,000 must be reduced while calculating sales? So when I look at sales over here, from this sales value, I will subtract minus 17,50,000. Further, from the materials consumed, I will also subtract 17,50,000. Sir, but there is some unrealized profit on stock. So this is 7 lakhs. Profit over here is on 20% on selling price. So 7 lakhs into 20%, it will directly come to 1.4 lakhs. You don't need to do 20 by 120 because this is 20% on selling price. So 7 lakhs is a selling price for Moon and cost price for Star. So 7 lakhs into 20%, 1.4 lakhs. And ये आपका जो total number आ रहा है 4375 plus 752.5 minus 140. 4375 plus 752.5 minus 140 and you will be left with 4987.5. This is your increase in inventory which you will subtract. Okay. Selling and distribution expense of Star include 2,12,500 paid into Moon as brokerage fees. So this will be selling and distribution you will subtract minus 2,12,500. Further, the second effect will go where? Well, we'll assume that this is included within operating income. Institute has assumed that. So this is less 2,12,500 from here. Similarly, general and admin expenses include 2,80,000 paid to Star as consultancy fees. So within general and admin, you will subtract 2,80,000 and that will also be subtracted from here. $2,80,000. Star uses resources of Moon and Star paid 50,000 royalty to Moon. 50,000 है यहाँ पे royalty minus 50 and hence the second effect over here we will also subtract 50,000, assuming all of this is from operating income. It may be from other operating income, then you subtract from other operating income. Institute has assumed that these are operating incomes. Prepare consolidated P&L for Moon and its subsidiary Star for the year ended 31st March 2021 as per schedule 3. So if I go to see for sales 33,250 plus 19,075 minus 1,750 minus 50 minus 2,12,500 minus 2,80,000. If I subtract all of this, this is around 50 lakh. 3,000, no 50 lakh, no 5 crore. 32,500 शायद से. If you review this, 5 crore, 32,500 after doing all of these adjustments. 1, 2, 3 and 4. Acha, next you look at other income. Within other income, you will have these two things. Dividend, Institute has done no adjustment. We will also not do any adjustment. This is 1680, 437,500. That is 21 lakh, 17,500 and 350 and 1 lakh 5,000, which is 4 lakh 55,000. Total comes to 25,72,500. 25,72,500. Now, when you look at materials consumed, you will have raw materials 1 and 2. This is 13,930 and 4,725 minus 1,750. Can I say this is 16,905? This is 16,905. But there will also be production expenses that you will take over here, which is worth 45 lakh 50 and hence 2 lakh 214,55. Now, the problem is changes in inventory where you will do closing minus opening. Get these numbers for minus 1 lakh 40. Can I say 49,87,500? As you can see over here, 49,87,500. This you will subtract, remember, because this is an increase in inventory and hence this will be subtracted. So you will do closing minus opening. जो भी number आ रहा है, that will be your increase in inventory minus unrealized profit in stock. That number will be taken in the P&L. Remember the steps: closing minus opening. That'll give you the increase in inventory. From that, subtract the unrealized profit. Get the net amount. That net amount will be subtracted if it is a positive amount, because there is an increase in closing stock. Okay. Next, you will have wages and salaries. You will total it directly. Depreciation, total it directly. Finance cost, total it directly. But when we look at other expenses, you will have less intercompany brokerage, you will subtract. Intercompany general admin, you will subtract. Royalty to 0 ho jayega, and hence loss you have taken over here as 262. Institute has taken it as a reduction from other income, and that's about it. So when you post all of these numbers, you will get the profit. There is no tax given, and then you will get the profit after tax. Can I say it has slightly bigger numbers? Maybe a bit more calculations, like you have other income, you have royalty, maybe you have opening and closing stock. But at the end of the day, can I say that is based on question number 13 core concept base? Yes. Okay. So that takes care of question number 14. Now next you will go to your classwork section. I think question number 6 or 7 over here in your classwork section. Go to question number 7. Now this is the question on consolidated P&L. This is there in the institute study material. All of them you can see will be on similar lines. Given below is a P&L for H and its subsidiary S for the year ended 31st March 2017. So you have all of this data which is given for H and for S. Other information: H sold goods to S of 120 lakhs at cost plus 20%. Inventory: sold goods of 120 lakhs at cost plus 20%. Inventory of S included in such goods valuing 24 lakhs. So over here, first of all, in my revenue, I will subtract minus 120. In my raw materials consumed also, I think this is minus 120. Okay. Next, there is 24 lakhs. So 24 lakhs, this is cost plus 20%. So 20 upon 120. And hence, this is 24 into 20 by 120 comes to, I think, 4 rupees. So if I look at increase in inventory, if any, we have increase in inventory, yes, minus 4. Second effect will go against inventory. Admin expenses include 5 lakhs paid to H as consultancy fee. Selling and distribution includes 10 lakhs paid to S as commission. So over here, minus 5 and minus 10. H holds 80% of equity shares of 1000 prior to 15-16. That's fine. 20% is belong to minorities, but in P&L, Institute does not show anything for that. H took the credit in its P&L account for the proportionate amount of dividend declared and paid by S for the year 15-16. That is fine. Institute does not do any adjustment over here, so we will ignore the same. Ideally, you could have done an adjustment, but Institute has always ignored it, so we will do that. In 1 July 21 paper, they have done some adjustments, but that question is wrongly done because you have acquired somewhere in the middle of the year. Remember, this is not balance sheet, this is P&L. If you have acquired, let's say, stake in the middle of the year, let's say in July, then you will consolidate the subsidiaries' revenues only to the extent of 9 months. You cannot consolidate for the entire 12 months. If the stake was acquired from the beginning of the year, or it was there since the last year, then the entire year's revenue will be consolidated. But if it is acquired during the year, revenue after the date of acquisition can be consolidated. Prepare a consolidated P&L account. Okay, so over here there's nothing new. Sales and other income, if I go to see, will be, let's say, 6000 minus 120 comes to 5880. Increase in inventory, this will be going over here within expenses. Increase in inventory is 1200 minus 4. This is 1196, which you will say less, 1196 over here. Next is raw materials consumed. This will be 800 and 200. अच्छा, hold on. यहाँ पे minus 5 and minus 10 यहाँ पे भी आ जाएगा. I forgot that. So 5880 नहीं आएगा. This is 5000, 6000 minus 120 minus 15. 5865. Okay, then raw materials consumed will be probably 1000 minus 120, can I say around 880 plus production expenses over here will be, I think 200 and 100, that is 300. Wages and salaries will be 950, no adjustment here. Admin expenses will be in other expenses, I think 295. Selling and distributions 240. Interest 150. Depreciation also 150. Profit before tax, provision for tax, maybe if you have to show, this is 1400 provision for tax, and that is profit after tax. That's about it. So if you review question number 7 over here, I think 13 we discussed. If you review question number 7, revenue is 5865. Cost of materials will be 1180, that is 880 plus 300 of production expenses. Okay. Next you will have 1196 changes in materials. EB is 950, depreciation and finance cost is 150, and then in other expenses, वही same घिसा पिटा adjustment. You will have 295, 240, and that's about it, 535. And then last में institute ने तो provision for tax भी less नहीं किया, but if you want to show, you subtract that and get your profit after tax. Do I need to show any attribution to minorities? Not required. Do I need to do any workings for dividend separately? Not required. Are we clear with this? If this comes, this is extremely scoring, and you should not lose on these fairly simple marks. Now, this takes care of consolidation by and large as it stands. The only other question which is there over here is question number 19, which came in the September 24 paper. Now, this involves some application of AS21 as well as some application of AS23. If you have not done AS23 as of now, you will skip this part and do that later. However, if you have done AS23 and have a fairly decent understanding of the equity method of AS23, we can discuss this and get done with the consolidation, all questions. Okay. So over here, you will have two companies where you acquire a stake. In one of the companies, you will acquire, let us say, a majority stake whereby AS21 will apply. And in one of the companies, you will probably acquire just about 20, 25, 30% stake, for which associate accounting will apply. Now, when we look at associate accounting, just a quick review. We will record the investment in associates at what we call as carrying value. And carrying value is using the equity method. And equity method, you will take your share of the profits and your share of the losses. Will you take over the assets and liabilities of the associate? No. Will you take over the assets and liabilities of the parent entity? Yes. But you will not take over the assets and liabilities of the associate in your working. So keep that into consideration, and then we will proceed. Now, on 1st of February 2024, Best acquired 80% of equity shares of Cool for 14 lakh 80. Now, this was acquired on 1st February 24, 80% shares, and hence this is a subsidiary. On 31st March 24, that is the very last day, Best also acquired 25% of the equity shares of Good for 3 lakh 80. Now, at 25%, this is an associate relationship. At 80%, well, this is a subsidiary relationship. Okay. Now, the following are the balance is extracted from the books of Best, Cool, and Good. Best is the parent, Cool is the subsidiary, and Good is the associate. As on 31st March 2024, equity share, securities premium, 9% debentures, general reserve, P&L, investments. So this is P&L, let us say after all adjustments, investments, PP, current assets, trade payables, including bills payable, sales and other income, raw materials, wages and production expenses. So you have been given a few data points over here. Now, the profit and loss of Cool showed a credit balance of 30,000 on 1st of April 2023, that is at the start of the year. The general reserve balance has been brought forward from the previous year. Okay, so there's no increase in the general reserve. The entire general reserve is pre in profit and loss. There must be some profits during the year, out of which the first 10 months of profit will be pre because the acquisition is 1st February. Last 2 months of profit will be post. On 31st March 2024, all the bills payable by Cool were acceptances in favor of Best. However, on the date, Best held only 3 lakhs of these acceptances, the rest having been endorsed in favor of its creditors. We have done this adjustment earlier where you will do intercompany elimination only of the bills which have not been endorsed and are intercompany. Best purchased goods costing 5 lakhs from Cool on 1st June 2023 at a price of 6 lakh 50. The entire goods remain unsold with Best at the end of the financial year. Best had purchased goods from Cool. So this is an upstream transaction. on 1st June 23. That is before the date of acquisition, and hence this will be unrealized upstream profit to be adjusted from pre-acquisition profits. Now, best is preparing consolidated financial statements for the year ended 31st March 2024. Okay. Now, you are required to find the trade payables consolidated. Now, if I look at trade payables, will I take over the trade payables of, where is this? Will I take over the trade payables of best? Yes. About cool? Yes. But will I take over the trade payables of good? No. Because I don't do consolidation of assets and liabilities of the associate. However, even over here, I will have a minus 3 lakhs if I'm not wrong, intercompany elimination for these bills. And as a result, if I go to see, this will be what? 3 lakhs here. This will be 3 lakh 80 plus 4 lakh 10 minus 3 lakhs. Can I say this is 4 lakh 90? That's about it. It's actually better that questions like this come because you get a lot of stepwise marking for every working. Then current assets, which are consolidated. Achha, when I look at current assets, this is 965. Okay. 560. Achha, yahan pe bhi in current assets 3 lakhs. Intercompany elimination will come. But other than that, there will be some unrealized profit in stock as well. So iska to pura effect humne de diya. Both the effects have been given. But there is some unrealized profit in stock as well, where they have said purchase goods worth 5 lakhs at a price of 6 lakh 50. The entire goods remain unsold at the end of the financial year. So over here, this is minus 1 lakh 50 unrealized profit. Again, you will not take this over for the other company. So this is 965 plus 560 minus 3 lakhs minus 150. Can I say this is 10 lakh 75 if I'm not wrong? 10 lakh 75,000. Current assets. Then you have minority interest, goodwill or capital reserve on acquisition of cool, goodwill or capital reserve on acquisition of good, and profit and loss consolidated. This is like working note number 3, working note number 2, and working note number 1. And then a similar working is also required to be done for associates. So we'll do that separately. Okay. Next, general reserve consolidated. Again, this is along with working note 1, you'll have consolidated reserves. Revenue from operations consolidated. So when I look at revenue from operations, I will take what? Sir, I will take 56 lakhs. Okay. Will I take 38 lakhs pura? No. I will take 56 lakhs plus 38 lakhs if this is accruing evenly throughout the year into 2 by 12. Because only the last 2 months revenue will be consolidated. 38 into 2 by 12 comes to 6.33 plus 56 comes to around 62.33. Now one might also say that, sir, we need to eliminate intercompany sales. In this case, no, because these sales were done on 1st of June 23, that is prior to the date of acquisition, and hence when I take over the sales, ये sales के अंदर, that is 6.33 के अंदर वो है ही नहीं. And as a result, you don't need to separately eliminate it. You could have eliminated it if the sales were happening in the last 2 months, which you have consolidated, and hence you eliminated the first 10 months of sales. You have not consolidated only. So how can you eliminate it? Acha, the cost of materials consumed or purchased. So when I go to see over here, this will be 3650 and 3120. Now ideally this will be 3650 plus we can say 3120 again into 2 by 12. 31.2 into 2 by 12 comes to I think 5.2, and hence even over here there will be no elimination. So this will be 41.7. Now ideally I can also separately add if I want to production expenses. I believe Institute over here has not done that. Having said that, if you want to add, you can also show it like you did in earlier problems. Are we clear with this? Okay. So this is point 8 and 9 done. Now if you look at your other workings, like in your consolidated P&L account, your consolidated P&L account will be 326 to start with, and generally this is 269 to start with. So this is 326 in the P&L, 269 in the general reserve. Okay. Then for goodwill working, you will have investments. Investments that you have done, I think the investment amount was 14 lakh 80. This is 14 lakh 80. And from this you will subtract my share in the net worth on 1st of February, out of which equity share capital of Cool will be 20 lakhs. 20 lakhs into 18%. Can I say 16 lakhs? So यहाँ पे ही आ गया. अरे बराबर क्या नहीं? So this is 20 lakhs into 18% and that is 16 lakhs. And then when you sit to calculate the profits you have been told general reserve is entirely from the previous year. So when I look at general reserve of 84,000. अच्छा यहाँ पे अपन एक काम करेंगे minorities interest. In minorities interest you will take the other 4 lakhs of share capital plus in general reserve 84,000 into 20%. 16,800 and pre-acquisition general reserve will be 84,000 into 80%. 67,200. General reserve is taken care of. Nothing will come in the general reserve. Associate में तो ऐसे भी you are acquiring on the very last day, so nothing is going to come from the associate. Then you look at the P&L balance of 2,70,000. Starting में कितना था वैसे P&L balance? 30,000. So can I say 2,40,000 is earned during the year? So 2,40,000 divided by 12 comes to approximately 20,000 per month. In the last 2 months, this will be 40,000. In the first 10 months, it will be 2 lakhs. So over here, this will be pre-acquisition P&L. This will be 2 lakhs. Can I say into 80%? 1,60,000. In the general reserve, in the minorities 40,000. Post acquisition you will have 40,000 into 80%. 40,000 into 80% comes to, I think, how much is that? 32,000. So we'll add 32,000 over here and the remaining 8,000 will again be attributable to minorities, and I guess that should be it. Nothing else is there. So over here, if I were to do the workings for these, I will say 16 plus 67 lakh 26 7.2 and 160. 16 lakhs 67,200 1,60,000 is 18,27,200. So I believe यहाँ पे capital reserve आ जा रहा minus 1480. 347,200 of capital reserve. So this must be 347,200 of capital reserve. 347,200 of capital reserve. Next, when you look at your consolidated profit and loss account, 326 plus 32, 358. Nothing from the associate. And general reserve 269. Again, nothing from the associate. Sorry, this is 269. And then when you calculate for minorities, this is what? 4,16,800, 40,000, 8,000, probably 464,800. Okay, next the only thing which is remaining is your goodwill or capital reserve on acquisition of goods shares. So when I look at goods shares were acquired for 3,80,000. My share in the net worth as on the acquisition date is 10 lakhs plus 0 plus 1,20,000 plus 50,000. So this is 10 lakhs plus 1,20,000 plus 50,000 comes to 11,70,000 into 25%. This is 292,500. So out of this 292,500, you can do that in the associate working. You will compare 3,80,000 for a 25% stake compared with probably around 11,70,000 into 25% comes to 292,500, and hence the excess that you are paying above that is around 87,500, which will be disclosed separately as per AS 23 in the associate working. Are we clear with this? So this will be 87,500, which will be disclosed. So these are the workings if required for question number 19, and that by and large takes care of question number 19 as well, which is also an important question from an exam perspective. Perfect. So this largely takes care of consolidation. I hope you are broadly clear with the sums and the process and the application. Ensure that in consolidation you master the process first and then the adjustments and then the combination of two, and you will not go wrong. You will definitely score really good marks in consolidation. Okay, chalo, that should be it. We will stop and we'll see you soon with another session. Till then, keep studying hard and good luck. Bye bye.